All right, welcome everyone. Appreciate everybody tuning in to the Competent Investor, the first space that I'm going to host as in the Competent Investor. Bob, thanks for joining me and thanks for the suggestion of doing this afternoon.
Sure, Tom. How you doing?
Excellent. It's good to chat with you again, and looking forward to going through everything that's happening in the markets. It's pretty crazy time. Pretty interesting to see what's happening, and also interesting to, I think get everybody's temperature as this bull market really develops that a lot of us have been waiting for such a long time, right?
Yeah, definitely. And there's an old saying, it's not your father's markets, and certainly this is not your father's markets. With the advent of a lot of financial engineering, all the money printing, the options markets, the derivative markets, the broadening of that, the global demand for metals. I always told people, and I see David Morgan in the audience there. We've always talked about this is the next move higher. 10 years ago we were talking about it's going to be a global story. It's not going to be like the 1970s where it was mainly based off of the U.S. This is something that's global in nature. So you have to understand some of the dynamics that are happening. Not just in the U.S. and on COMEX, but you have to understand London. You got to look at, obviously, China's been a huge player in this market. India's been a big player. Asia's had a huge impact. These are stories and fundamentals that kind of guide you. They're not necessarily the greatest timing vehicles for trading, but it gives you sort of, is the wind to your back or is it a headwind? And these are the types of tools that I try to help promote and educate with on X. Just trying to so because I know a lot of people are looking at the markets and like, my God, why isn't gold at 10,000 an ounce right now? Or these things take time to develop, and of course, bull markets, they tend to go up when you least expect them, and then of course, the nature of a bull market is to buck as many off as possible along the way. So,
well, I know that $50 level is so important. I mean, the $50 level and the $4,000 level for gold are going to be these all important, very round numbers that we're facing here pretty much immediately. But starting with silver, Bob, what do you think has changed in since the last bull market in the way that people look at silver, and silver being an industrial versus a monetary mint?
Yeah, there's a lot of, in the market itself, there's a lot of market structural differences from 2008 to 2011. You have to remember the open interest in the futures markets has not really expanded in this last run that we've seen. So you don't have when a margin call, or sorry, when a margin hike comes in, you don't have a lot of longs participating on with leverage in the COMEX markets or futures markets that you had in previous cycles. So, you'd see these big whipsaws with silver in the past, and we've seen a few of them in this run here. Obviously, we saw it in April where you had this big move from 34.5 or so down to 28.5, and then overnight or in the afternoon, after I guess during Globex hours, you had a very big, well-known trader supposedly come into the market when we were at 28.5 on silver, bought $32 call options. Literally within 3 minutes, silver moves a full dollar back up to 29.5. I mean, you get these whipsaws, and people have to remember the silver market is very tiny compared to a lot of other financial markets. It can get pushed around a lot. You get the stops get run on both directions to the upside or downside, and that's where you get these these sort of big drops or smashes in price when they go down. But that's typical with a lot of commodities and even in stocks. The old adage, it's an escalator up and an elevator down. But it's just managing that and understanding it. And I know on the manipulation side, maybe I don't make myself clear on this topic, but we can get into that too, but how I kind of view, the precious metals markets relative to, the entire market and so forth. But yet you have with President Trump in office, that's created some very unusual moves that traditionally don't happen very often, but it's been happening a lot this year. The exchange for physical premium, the spreads between London and New York blowing out to the upside, in terms of going to a very fat contango where the futures price is a lot higher than the spot price. And now you're the exact opposite, where now the spot price is higher than the futures price and what they call a backwardation. Mm-hmm. And so you may be prepared to start seeing silver moving, I hate to say this, moving back to London. There's going to be a point where it's beneficial price-wise to load out of the COMEX and then pay for the shipping. That spread will be wide enough that'll cover the shipping costs. And, that metal will then be used to help sort of put the fire out, if you will, the leasing rates and the tightness that's over there. That's the market working. That's just, when what you call arbitrage, when you have one location or one exchange, for example, that's mispriced or maybe priced differently, where players can actually profit via risk-free, they will take advantage of it. And we saw that at the beginning of this year, where banks were the biggest buyers of precious metals in the marketplace and delivering just a tons of metal onto the COMEX and selling futures contracts and capturing that exaggerated exchange for physical spread during the process. And I think it was, I think I posted this before, the first quarter of this year, banks made about $500 million from the trading of precious metals.
So Bob, let's unpack that a little bit. Let's start with backwardation versus contango. Give us a quick definition there for those that aren't familiar.
Yeah, basically, typically in a normal market environment, especially when you have interest rates at plus 4% or so, it's very normal to have the futures price higher than the spot price. So for example, right now, the December contract for gold and silver are elite month contracts. And so when normally you look at, 2 months out, you're kind of taking into account the time value of money, the cost of carrying, the storage rates, all that kind of stuff. When you mix it together, you need typically a higher price in the future to make up for those costs. It's just nature of money. And what happens is there are times where, if there's a lot of demand, physical demand, for example, that spread, that normal spread that you typically see will start to contract, meaning people will sell the future price of that silver, the paper price of that silver at a future time, and say, listen, I don't need it then, I need it now. And so they'll pay up for the physical that they may need at this moment. And that could happen, whether investors feel maybe not very confident on, the future of the markets or the political future or just uncertainty in general, or fabricators say, listen, we just had a rush of orders come in that we weren't expecting because the entire summer was just dead. People were selling back premiums or everything was at discounts to spot. And now all of a sudden you had the U.S. Mint 2 weeks ago, they were offline for 2 weeks just doing an audit, so they weren't making any product for 2 weeks. And you had this perfect storm where all of a sudden this rush of people to buy, and you kind of took out a lot of the sort of excess inventory that wholesalers had, and now you have prices on products are starting to go up. And so refiners out there and private mints are like, well, okay, now I need to get product made, so I got to go out and buy these 1,000-ounce silver bars, and I'm willing to, to buy them at X because I need them to make the product, so I can, make my living selling, a fabricated product at a higher price. So hopefully that gives a little bit of. Does that kind of help a little bit?
Yeah, absolutely. But I think the other question I had in that first explanation here, Bob, is the idea that silver would end up coming back to London? Why would it be coming back, and where would it be coming from?
Yeah, what's happening in earlier this year when you had the tariff worries and concerns, you had a lot of metal people that were hedged in London. They own the physical in London, and typically the New York markets are a hedging market. The futures is a traditionally seller's market where a lot of hedging takes place. And so you may have the metal over in London, but you're shorting a futures contract, and as these prices on the futures markets are higher in price than your spot physical product or physical metal, you can enjoy a sort of arbitrage at the profit, as well as hedge the price action of your underlying physical position. So what was happening when Trump was talking about tariffs and so forth was now your metal that's sitting in London, for example, or Singapore or Mexico or wherever it may be, all of a sudden you had this concern because the presidential administration was talking about, hey, listen, we're going to slap tariffs on Mexico, Canada, Australia, China, whoever. They already had tariffs on China. But the issue you run into is the silver bars that you had in physical inventory, if they happen to be country of origin or product of origin bars from a country that may all of a sudden get slapped with a tariff, and then you had to take those 1,000-ounce bars, for example, because you shorted a futures contract, and your intention was, hey, listen, I'm hedging, but if I ever needed to, I could deliver this metal against my short futures contract if I had to make delivery. But now all of a sudden, that delivery mechanism is strained because all of a sudden, say the bars that you had in London were Royal Canadian Mint bars, and Trump is getting ready to slap a 25% tariff on Canadian products. Trying to bring that Canadian bar into New York to deliver against a futures contract ran the risk of a 25% additional cost on the value of that metal. It's something you could not hedge. And so all of a sudden you had the doors opened up and people are like, well, wait a second, I got to get this metal to New York before the potential tariffs, if they ever do kick in, we got to get them in before that does actually, if it happens. It's a risk that we cannot afford to take. So you had this just absolute logistical sort of rush to get a lot of metal, gold and silver, for example, and even platinum into New York, into the COMEX depositories in a very short period of time. And that's where you saw this explosion of ounces being stored in the COMEX.
So again, Bob, where is that metal going to come from? Is it going to come from the States? Is it going to come from China? Like, where is that metal going to come from back to London, you said?
Okay, now we saw the metal come in. I mean, you're talking, we reached almost 200 million ounces in the registered category of silver, for example. I think it's north of 500 million ounces total between the registered category and the eligible category, for example. I'll pull up the quick numbers here. 530 million ounces between metal that's put on receipt back in a futures contract, and then you have 341 million ounces that are sitting in an eligible category that's basically private storage bars that are eligible to be put onto, they meet all the qualifications to be put onto a futures receipt, but they're owned in private hands. Well, that metal came from all over the world. So a lot of that metal could easily start pouring back out of these depositories and going back to where potentially they came from, or potentially if it's London, it's in sort of this tightness and potential profit, arbitrage profit that players can capitalize on. A lot of that metal may be segmented to go directly back to London because to meet demand from, whether it's ETF capital flows or fabrication demand or just basically bank trading and lending and so forth that's happening in London. There's a demand there, obviously, for physical product, and you see it with some of the financing rates. They're elevated, so they're showing that there's tightness or stress over there. So in New York, you're sitting here saying, well, God, now the spot price is now larger than the futures price, it doesn't make any sense for me to continue to pay storage fees, the cost of rolling contracts, and I'm not getting. And when I roll, say for example, get out of December's contract and you go to the next lead month contract, which I think it's March for silver, that spread, that time value spread may not be wide enough. For example, that futures price may not be high enough relative to the spot price that makes any sense to basically lock in or short against my physical existing inventory. So, bank or whoever it may be that owns that inventory says, listen, maybe I just will sell it over and capture that arbitrage from what I can roll for in New York. I can just take the physical metal, ship it over to London, and just lock in a profit because that price is higher than what I can get for example, over here in the United States.
Mm-hmm.
If that kind of, it's a little bit complicated and convoluted.
Yeah, that made more sense. Like that clicked for me as you were explaining that, with the difference between storage and everything versus shipping it back. But in the case, let's say, of North America here, has the market over the last, let's say, 5 to 7 years here, how it's evolved, has that really kind of created a choke point of sorts in the physical delivery market because of the way that things have evolved?
Not necessarily. I know we had a big sort of panel discussion on back in 2022. We talked about when Basel III was being implemented. There was we had talked about it, and my premise was basically the market was going to deleverage, and you were going to see less activity on, for example, less incentive for banks to basically, with these unallocated accounts and so forth, to play the leverage game and use their balance sheet to take on more risk. Basel III kind of said, listen, if you're going to do an allocated program, for example, say you have a bank client that wants to buy silver or gold, the bank goes, listen, we got two products. We have an allocated product that says, listen, we'll buy the gold in your name, we'll put it in the vault, and it'll be under your account. Or we have this latest and greatest product called unallocated gold or silver, which basically says you don't have to pay any storage fees. We'll give you the exposure to gold and silver. If you ever want to take delivery, we can provide it, but at least this way you don't have any storage fees. So like a moth to the flame, a lot of players in the past said, well, God, that's a great deal. I'd rather do that and not have to pay storage fees. But what they didn't understand was the bank wasn't going out and buying gold and silver. They were using their balance sheet to be the offset or the counterparty to that gold and silver account. So for example, if gold and silver went up and the bank didn't buy any type of products that match the price exposure, all of a sudden they would have potential losses there if they were just basically using their balance sheet just without any investment in whether it's paper gold, futures, real gold, whatever it may be. So what Basel III came about, it's stated that, okay, you're going to have to put up 85% reserve ratios or reserve funding if you're going to offer a program like that. You're not going to be able to get away with that now anymore with just completely leveraging out your balance sheet and creating this sort of liability for yourself. You're going to have to pony up some money. And that started to delever the banks and their profitability in the unallocated type of program. And that's one of the reasons why I think you started to see, at the same time, you started to see Asia really start to develop their markets and start to really become, they've already been big players in the physical metals markets, but they started to really shine. And they were buying a lot of metal. In 2022, we had the West was sort of selling off their metal, especially on the paper side. They were selling it down. And in fact, we went to a backwardation in the summer of 2022 and all the way into, I think, September, October. And at one point, I think in August, all four precious metals were actually in backwardation together, which had never happened before, at least I'm not aware of. And it was just a sign that at that time, India was just buying an enormous amount of silver at the time and gold. And so that pressure started to put, or that buying pressure put that the metal into a backwardation here in the United States. Because back in the here in the United States, you had the Fed was trying to do QT, and rates were going up, and so typical managed money would say, listen, rates are going higher. That's typically, in their playbook, bad for commodities because it's a slowdown in the economy, where we're going to short the piss out of gold and silver, or start to go or sell it off. And that's what they were doing. And so, but the playbook had kind of shifted and changed, which they didn't see at the time. And that's what all of a sudden that created a low. I think it was in October. The market kind of chopped around in 2023. And then by the end of 2023, the sentiment got so bad, especially on the retail side, that to me, I spoke at the Silver Symposium. I think it was in Las Vegas in October 2023. And I said, listen, this market's going to turn and no one's going to trust it. And the retail is going to sell all the way up. And that's exactly what kind of happened, because a lot of people were just burned out because you had the silver squeeze in 2021 that never took hold. The only thing that really got squeezed was the premiums. The industry made a fortune, I think, off the retail public. And then that frustrated a lot of people. It reset the market. And then it kind of actually opened up the doors for early 2024 when people were just distraught with mining stocks and everything in the precious metals realm. That set the stage, I think, for the washout.
Yeah, it's interesting how the interplay between the paper markets and the physical markets have kind of had this push-pull cat and mouse game back and forth. And I'd like to get into that further a little bit later, Bob. But specifically, I've been hearing that there's a possible volatile situation, let's say, kind of stacking up, that is related to Sunshine Mint and just the kind of the inability, or let's say unprofitability, of many of these fabricators to make blanks, and how that affects the silver market particularly. Is that something that is, let's say, on your radar, or that you can see as a risk in the actual physical supply side of smaller coins or smaller bars and coins?
Yeah, I think your comments really focused very well on what was kind of taking place from the beginning of the year, or even into last year, when you had so much selling back of metal. There was just so much secondary product on the market that you didn't need to buy brand new material. Unlike 2020 to 23, or 2020 to late 2022, there was so much demand that most people were, the only thing available, new product. People weren't selling very much. There was a little bit of selling, but for the most part, it was new product availability was the only thing that was out there. And you have to remember that setup in 2020 to 22 was basically, we had peaked in 2011, went to a tremendous bear market leading up into 2018 and 19, when the market went absolutely just flatline dead. A lot of people were losing money in that market. And then so there wasn't any need to increase inventories at that time or build up inventories, because it was just, you had gold eagles that were being sold back at discounts to spot. It was so bad that proof gold eagles in 2019 were actually cheaper than just the bullion gold eagle coins. I mean, it was just that type of environment. So that set the stage for this sort of perfect storm, where all of a sudden you had COVID, you had social distancing, you had the inability to make as much product as you wanted to, because of logistics, because of inability to get materials, or the cost of moving the stuff was impacted, or ability to move it was impacted, and then obviously to make it and so forth your employee staff was diminished somewhat. So you had this kind of perfect storm. But now what you have, you had a lot of selling this year. You just didn't have the need for a typical refiner to make a lot of new product because there was just so much secondary product on the market that was pushing down premiums on rounds and bars and so forth. And it just didn't make any sense, for refiners or for private mints to compete with that. It was very difficult to.
Mm-hmm.
Now what you have, again, the cure for high prices or low prices is high prices or low prices. You have now the situation where the summer doldrums kicked in. People were kind of dribbling and selling into the market. No need to increase inventories because you had plenty of it on secondary stuff. And then all of a sudden, Labor Day rolls around and market takes off. And people that were watching it, looking for a pullback, sitting on the couch and waiting, all of a sudden silver blows through 40, and you start to get this nothing like prices to motivate people to buy metals. Yeah, they could care less when silver was at 20, but at 50, it's like, my God, I got to have this stuff. It's like the second coming. And so that's just how the Western world works. It's kind of odd, but people buy on momentum. They buy on, they chase. Maybe it's a bias confirmation, but it gets people into that buying mode. And that's kind of what basically took place after Labor Day. So that, and then the type of buyer that came into the market, I don't think was necessarily your typical precious metal stacker per se. Yes, they buy, monthly, or, they buy periodically. But what we started to see this year was, and in the last year, was the buyer was typically a higher net worth individual that would come in and buy larger sums of money of metals and say, listen, this is, 5% of my portfolio. I made a boatload in the stock market. I've never owned metals before in my life. I see everything that's happening. I want to start looking at, starting to take positions in for my portfolio, and the physical metals make sense, or GLD or SLV, whatever it may be, makes sense. But you started to see the size of the transaction greater, but the ticket count more diminished, if that makes sense.
So are you saying higher value buys, but less overall volume of customers?
Yes. Mm-hmm. And what was happening now is when those buyers come into the market, they will wash out one product. For example, let's say they come in and buy a boatload of Silver Eagles. The Silver Eagle premium may go up first, and unlike 2020 to 22, where all of a sudden Silver Eagles go up, everything else goes up with it, you're seeing particular products become tight all of a sudden. At the same time, you're still getting selling back from the public, but it's like a give and take. Some days you get more selling than buying, mm-hmm. Other days you get more buying than selling. So these products, when the bigger buyers come in and they wash out, like say they want to buy all 100-ounce bars, they can wash out the inventory very quickly, and then all of a sudden that one specific product, the premiums start growing up on it. And that's what we kind of started to see this year. It was sort of this ebb and flow, and it kind of, now what you see is the backdated sovereigns, like Eagles took off. They're up about $1 in premium on the wholesale market since Labor Day. You're seeing now the backdated, for example, Austrian Philharmonics, British Britannias, South African Silver Krugerrands, those are starting to rise. And Maple Leafs had been rising as well, but you're seeing backdated stuff lift on the bids and the offers at the moment. Mm-hmm. And then rounds as well. They've been actually moving higher as well.
So let's now go into this, let's say this interplay between the paper and the physical markets here, Bob. You've been posting a lot about how SLV, they, for example, yesterday issued 5 million more shares. So let's start with just the significance of that issuance of 5 million more shares yesterday.
Yeah, you have to understand with ETFs in general and how they're structured, and I'll say this somewhat, and I've said this before, people have to understand, or investors have to understand, when they're buying an ETF, they think they're buying a product. What they don't understand is they are the product. ETFs make their money on flow, on the authorized participants who interact with the sponsor of the ETF. For example, with SLV, it's BlackRock. BlackRock is the sponsor. The authorized participants are like the broker dealers. They provide liquidity to the ETF. Like, for example, with silver, they'll provide physical silver in exchange for shares, and then they'll also redeem shares and then get back the physical silver. But they'll provide that liquidity depending upon the flow of capital going into or out of any given day with the silver ETF, for example. Mm-hmm. So in this instance, and every day these things trade at slight discounts or slight premiums. So there's also incentive for the authorized participant at any given time to capture these discounts or premiums with the interaction they have with the ETF. So for example, if the physical silver is more expensive than the shares, meaning the shares are trading at a discount, they'll buy the shares, deliver those cheap shares back to the SLV, and then take back more expensive physical silver and collect an arbitrage profit from that. And so there's ways that these ETFs actually work in unison with the markets, but at the same time, they have impacts or influence over the price of maybe the underlying commodity or the market that these commodities are traded in. And that's where we get into the manipulation and management influence of the markets. I mean, we can get into that in a minute, but the ETFs have a lot of impact on the day-to-day pricing structure of whatever commodity or whatever market these ETFs impact. And you've seen just an absolute growth in inflows into precious metal ETFs this year. So understanding all that, you have to remember these authorized participants, whether they're like Morgan Stanley or Goldman Sachs or Virtue Financial or Cantor Fitzgerald or whoever it may be, they're very big trading firms, market makers. These firms also are market makers, for example, for the options side of the market as well. So you have the interaction with options overlaid with the ETFs, and that's a whole new it's a whole other dynamic as well that influences the price of the metals, because a lot of this stuff is using leverage upon leverage. And so you get, especially with options, you have, the time value premium, you have volatility premium, you have gamma, which is the volatility of volatility. And, there's a lot of different pricing that goes into an option that, when the retail public goes in and buys a call, for example, the dealer will sell that call to the public, and now they're short a call, so that they'll then, in order to hedge themselves, so they tend to buy the underlying position of what that call is short of. So, for example, if it was SLV, they would go in and buy, for example, SLV shares. They wouldn't buy the shares on a one-to-one basis, because a lot of times these options premiums expire worthless. But that's where you start to get this all of a sudden where the volatility starts rising, the price goes in one direction, and if the dealer is caught maybe under hedged, they have to buy more underlying at that point, and which then potentially increases the price of SLV, and it's sort of a loop at that point.
Mm-hmm. So then what does it mean now? Like, give us an explanation that there's no shares available to be short.
Yeah, this is interesting, because like we were just mentioning, you mentioned yesterday 5 million shares were created. Typically that would have been, imagine like a fire that's on a house and a fire truck pulls up with the hose of water. Typically that 5 million shares would have been that hose of water that puts out some of the stress or some of the pricing dislocation that's in the market. And in the past, that's had a very positive effect or lowered that cost to borrow. But what's happening right now is they created 5 million shares, and all of a sudden, I think the shares went from, like 6,000 shares or something like that, or almost nothing yesterday available, to like 6,000 this morning, and all of a sudden, it dwindled away back to zero shares available. And again, this is actually Interactive Brokers, what they put out. So, it may be different with other broker dealers, but Interactive Brokers, I think, you could think of it as a sampling. They're a very, very big broker dealer. And so, being as big as they are, it's a legitimate pool maybe or sample to look at from availability. So if they're having difficulty lending shares out, that could be very similar to the rest of the marketplace. And so seeing this price to borrow or fee, the borrowing fee to borrow jump from 6.3%, it was like in the morning, back up to 9.82%, hitting, I think, a new high on this move. This is a dislocation. This is not a normal event. And this is what I try to watch for when you're trying to manage markets and for example, running a hedge fund and so forth, is you're trying to look at all the breadcrumbs out there. Not everything is, not every tool is the tool. You just try to take in as much data as you can from as different sources to try and give you an inference of how the market is shaping, if that makes sense.
Yeah, absolutely. I mean, there's so many different sources of demand, so many different sources of supply. And exactly as you said, there's the opacity with which this market operates in. You do have to take these breadcrumbs to be able to try to understand where the market's heading, how tight it is, and how much, volume, supply, demand on either side is there that is coming into it, right?
Yes. And so when you start to put all this together, think of it as almost an artist with a blank canvas, and you're throwing all the paint or mud on the wall or the paint on the canvas, and you're creating the picture. And sometimes that's managing money or managing positions. It's an art. It's not a science sometimes. Or most of the time it's an art. And that's what you're trying to do. You have to remember, I've been doing this since 1992. So I've been watching these markets for a long, long time. I've been through a lot of bubbles in my life. I've seen a lot of dislocations and so forth. And trust me, you learn a lot over the years. What you're seeing right now develop, though, is an environment where earlier this year, you had a lot of people deliver metal onto the market, and the futures market, I should say. They shorted a futures contract against that physical inventory that they delivered. Most of the players were like banks and so forth that were saying, hey, listen, I can make money by delivering metal and selling a futures contract and making this fat arbitrage or that the EFP or the exchange for physical spread was so wide that it was very inviting for me to do this. And they made a lot of money doing that. The problem with it now is it's like threading a needle. We're living in a world where a lot of this metal that's sitting on the COMEX, for example, has already been metal that's shorted on paper. So that metal and most of the shorts are in the December contract. And the issue with that is they have to wait till December to affect the short or go into that delivery month to then execute and deliver that metal to a long, for example. Or the only other way to unwind that is they got to close out that December contract, which means they have to buy the short back and then potentially maybe short the October contract. And then you got to remember, it's a short that controls the delivery process of in the futures markets. So if they want to actually get that metal out, typically what they'll do is they'll as you're short, you deliver against an existing long position. And then you can net the position out. The other way is that you get rid of your short position, and then if you have physical inventory, let's say not at the COMEX, then all of a sudden that physical inventory is free to move wherever it wants to move or to be sold into the marketplace. But these are the mechanisms right now that when we talk about, for example, in London, the free float, the amount of metal that's sitting in the London vaults that is owned by everybody. And as the ETFs have been growing, that existing other pool of metal that floats, so supposedly, has been dwindling. The metal, the vault data hasn't really jumped around a lot. So what happens is more flows of going to these ETFs, and most of the ETFs store in London because London's cheaper to store in than in New York. What happens is the free float of metal that's sitting over there may be owned by authorized participants or owned by banks or owned by other players. When authorized participants go and need the metal to create shares, they have to go in and get the metal somewhere. They're taking it, potentially from another account in London. All of a sudden, that shrinks that free float of available silver, for example. Mm-hmm. And so that's where this tightness starts to begin. Well, now you're getting to a point where now you're in backwardation, and if capital flows continue to come in through the ETFs, that will put pressure on the need to create even more shares. And then, of course, the only way you can create shares is by delivering the actual physical underlying product. SLV or GLD cannot actually accept, a promise or liability from an authorized participant. The authorized participant, contractually has to deliver physical metal, and then the sponsor actually will then create those shares or give those shares to that authorized participant. That's the authorized participant is the only one that can really create and redeem shares.
Yeah, that's something that you and I have gone over before, this idea that just because you have shares of SLV doesn't mean you have a possible claim to actual physical. It's a little bit different with PSLV, as I understand, but you still have to be basically authorized and of a certain size to do so. We have a question in the comments here come in. Super Signals asked, how does borrowing SLV shares provide players with physical silver?
Yeah, what you're doing is you're playing a game of paper. Your equity participants, the traditional equity market makers like Citadel and so forth. Earlier this year, when you had this big blowout of physical spreads and so forth, lease rates were really high and so forth. The tightness was developing in London. The concern of trying to move all this stuff over from other areas of the world into the United States, there was a dislocation there. And so what started to occur was you started to see these funds being used as proxies for pricing equivalents for the underlying product that they were holding. So, for example, PSLV, SLV, both saw an immense amount of increase in short sale volume, and so these equity market makers, they lend out these shares, for example, or broker dealers lend out these shares at these higher fees. They can actually essentially create a cash flow or revenue stream lending out shares, and then you have players that will borrow those shares and use those shares, for example, as a hedge against another leg of their position, rather than going into the physical silver market where maybe the lease rates were a lot higher or the cost of carry was a lot higher. You have to remember earlier this year, not only were lease rates higher, but also the cost of carrying was also higher. You had higher borrowing costs in the metals. Banks were increasing the borrowing rates for dealers to go in and borrow a sum of to borrow money to then buy metals with. And you have to remember when you're also borrowing to buy metals, these banks require these transactions or inventory positions to be hedged. They're not just basically, imagine like a wholesaler going in, with their line of credit buying silver 1,000-ounce bars, for example. They have to hedge that. And so you can either go into the futures markets and hedge, or you could go into, use other paper instruments to hedge that type of trade. But that's where the equity participation started to really occur. You never really saw this much before maybe December of last year. You really have to, on a consistent basis, you just have to look at the short sale volume statistics, and you'll see the massive, immense increase in short sale volume on and off the exchange.
Mm-hmm. We had another question come in, Bob. It said Saudi Arabia, Sean Wilson asked, Saudi Arabia recently bought shares in SLV. Could they possibly take delivery? And as my understanding would be, they'd have to be already an AP or an approved participant, right?
Yeah, they'd have to go through an AP authorized participant to basically affect that, deliver that basket of shares to the authorized participant. Authorized participant would then arrange the loadout from the ETF sponsor or the custodian bank that's holding, or the depository that's holding that metal. That would all have to be arranged, and it has to be approved by the authorized participant. Now, the authorized participant, is a broker dealer, so they're probably in talks with some of these larger clients and arranging, for example, when someone wants to take a big position, for example, in SLV or an ETF in general, they can actually talk to the authorized participant ahead of time and say, listen, we want to put, 100 million into this fund. We obviously don't want to dislocate the market and force the price of what we're buying at a higher price. Can you work this order so we can actually take a position? That happens too. It's not just simply, Saudi Arabia gets on the phone or goes on to E-Trade or whatever and just clicks on the buy button and buys, 50 million shares SLV overnight. That order is definitely worked through the channels. And so the authorized participant may be fully aware that the trade is being done. And then therefore, and that's what's interesting with typical market participants is they don't typically buy all of a sudden at one, they run the price either up or down in an extreme fashion. If you're a big player, you're trying to massage your order into the market. The problem when you have these big downdrafts or updrafts in the futures markets is, sometimes that could be the market making, or could be other players that are big players that want to take a position. They may initially start shorting the market down, hitting sell stops, and then they have buy orders underneath the market that then would all of a sudden trigger, and that's how they build a position. But that's Wall Street 101. That happens in every market out there. How big players are position themselves in markets that maybe aren't as liquid, for example, as the S&P 500.
So Bob, let's move into some of the manipulation talk, if you wouldn't mind. I know David, it doesn't look like he's able to join us here, but I know he released a recent piece on this or series on this. You and I have gone through it many times before. So how best do you think we should, or is it to go about actually, let's say, splitting up the ideas of manipulation? I think we need to be, of course, this is always a very nuanced discussion, and we need to be very deliberate about how we're explaining it. So there's obviously a difference between spoofing, short-term manipulation, long-term manipulation. So do you think those are the three best ways to kind of split it up?
Yeah, I mean, that's definitely one way to look at it. To me, maybe to set the story straight, I guess, if you look at the general markets or the system itself is rigged. Think of it as all the markets are whether you use the word manipulation or influenced or managed, they're all managed because of whether it's the banking system or the governments that are in control, that have oversight, or there's national security or sovereignty issues that try to control the market in a certain direction. That it's like walking into a casino. The casino's odds are against you and they're in favor of the casino, but you still walk into the casino and play a round of blackjack, with the hopes that you may win. You're thinking, I can count the cards, I can do different types of strategies to maybe get an edge somewhere. Well, investing or trading, whatever it may be, is very similar in that if you understand that the entire system is rigged, and this has gone on since beginning of time, it favors the few, unfortunately. But if you understand that, then the question is the system at that point manipulated, or is it can you understand the rules within the system and how the system works, and then try to operate within the system that's already that is rigged. It's like again, going to the casino, playing blackjack. You're counting the cards. The high cards are coming. You're betting bigger, hoping that you get that blackjack. And then you try to pull back when you think the low cards are coming. It's that same type of principle. So there's a lot of math and probability involved. But from a standpoint of manipulation, what I have seen in the marketplace, unfortunately, yes, the banks have, spoofing has been a very negative situation and influence on the marketplace. And it's not just precious metals, it's the treasury markets, it's Forex, it's LIBOR. I mean, there are so many, you look at some of these stocks that are, that are manipulated, that develop a short squeeze, and people that are, end up short a stock that may go tenfold against them, and then 2 years later the thing's bankrupt. But manipulation can happen in a lot of forms. The issue is, I see the system for what it is. The question is, how do you work within it? And unfortunately, what I tend to see in the years of being in business, especially in the physical metals markets, we opened up a depository in 2008. I've been hedge fund I've been managed. I think I started buying physical metals in 2006. What I've unfortunately seen is the manipulation of the public by the industry itself, the precious metals industry itself, having a much greater impact on people's portfolios than the spoofing that, for example, the banks have done. Yes, the banks have definitely impacted the price of the metals on a day-to-day basis, but over the long term, gold's up over tenfold since this decade. I think it's averaged 10% return this decade on a yearly basis. So the question is, has that manipulation had any impact longer term? I don't think so. But the problem is, what I'm seeing, unfortunately, is a lot of dealers using the term manipulation as a sales tactic to extract either money from individuals that are trying to say, listen, I'm trying to protect my purchasing power, and they pay excessive premiums for products. You see a lot of this with some of these telemarketer type companies that charge 80% markup, 60% markups on these fractional gold and silver coins, where they prey on sort of the retirement community and people that are novice in consumers that are novice to precious metals. You saw it a lot from 2020 to 2023. The word shortages being whipped around. A lot of these sales tactics that were very aggressive, a lot of misleading comments that were designed to sort of get people agitated to get them to buy. I mean, to me, that has more of an impact, unfortunately, than the spoofing of price. And the spoofing of price was actually to the upside and downside. It wasn't just selling, for example. The price actually, in a lot of instances, actually went up off of their spoofing. But talking to people over the years here, I've realized that a lot of people have been taken, and a lot of that purchasing power that they thought they were trying to protect was given to the dealer, and that dealer happens to be basically unregulated. There's no oversight watching them from a fiduciary capacity on what they charge their customer base.
So, why don't we take the other side of that, Bob? Like, why do you think it's just greed that is driving dealers to charge these high premiums?
Well, what happened basically in 2024, and people started to sell, I think you started to see the realization, I think, by the public, especially a lot of people that I talked to, they started to realize, well, wait a second, this is how much I paid for it. And now I go to sell it and I'm getting, $2, $3, $4 under spot for silver, where they paid $6, $5, $6, $7, $8 over spot for that same product a couple of years prior. So the spread that was not disclosed to them when the boom was happening in 2020 to 2023, and you had dealers that were saying we're going to the moon, and you had promoters that were saying, $200 silver, $5,000 silver, $50,000 gold. They were just throwing numbers out there. getting people to look at the bigger picture maybe and look up into the sky where they weren't, where the customer wasn't watching their kneecaps. And so what ended up happening was the consumer not knowing, they watch YouTube, they listen to these interviews, they may develop some sort of, relationship by watching the videos and saying, listen, I could trust this guy. He makes a lot of sense. I'm going to buy from them. And then they buy from the dealer, but not understanding, the spreads, not understanding the markup that they're paying, not understanding, the marketing and advertising that dealer is saying we're the lowest in the country, we're the lowest prices out there, we beat anybody. But in reality, they don't. They're much more expensive. And then you had this idea where a lot of these dealers were all charging the same price that were online, for example, because one of the biggest players does it. Well, everyone else can kind of get away with it. And the public only has maybe, in the age of the internet, they only have so many, people maybe to choose from out there, dealers to choose from. And so it's the complexion of the industry, unfortunately, got into this greedy type mode. And I know, because I know what I was buying from the wholesaler. I know what I was charging, and I was charging $2 to $5 cheaper per ounce of silver than almost anybody else out there. I just did not have it in me to mark this stuff up and make, a fortune doing it. I was more of that. I'm trying to take care of the customer because I'm trying to develop that relationship, because I'm going to see that customer on the other end when they go to sell. And my concern is that when everyone starts selling, the premiums are going to collapse, and naturally the products, the metals will go to discounts, because you go from a one-sided market of buying to a one-sided market of selling. That's exactly what happened. But that unfortunately was not really in the plan by the industry from 2020 to 2023. And the public picked up on that. And I think that created a very sour taste in a lot of people's mouths, that the pub started to disengage and not necessarily buy more physical retail product. And I think, unfortunately, a lot of action, has gone into certainly there's been a lot of buying of physical, but unfortunately, a lot of ETF flow has reestablished itself, because people are saying, listen, I don't want to have to overcome a 30% spread just to try and break even.
Sorry, Bob.
And I get that.
Sorry, Bob, repeat that. You kind of broke up there. What spread?
Yeah, where the average investor says, listen, or consumer says, I just can't try to make up a 20 or 30% spread between the bid and the offer before I can make money. I'd rather just go into an ETF, for example, and just buy with a very, very tiny spread, that if if silver goes up a couple bucks, I can sell it and make money. Whereas silver goes up a couple bucks and you buy from a retail dealer, you're still underwater when you go to sell it back.
Mm-hmm.
And that's nothing.
Go ahead, Bob.
Yeah, it's not. I don't. That part of it, I totally get. Dealers have every right to make money, and that's great. I want to see them be profitable. I want to see them, be in business, because they're trying to maybe spread sort of the environment or education about the need for precious metals. It's just that the public has to realize this isn't like the securities market, where you have regulation and oversight and compliance and fiduciary roles and capacity and licensing and all that. It is literally just a buyer beware market.
Mm-hmm. Well, you and I have had this conversation many times, and I really think that trying to get accurate, non-sensational information about this market, about the metals, is, let's say, the best service that we can provide for, the people that are coming into this. I don't have anything to sell. I never did. And, knowing and meeting some of these people and seeing exactly what you were saying, these voters come into the space, and as a byproduct, also watching them go out of the space very quickly as well. They promised people the sky, and they didn't deliver on what they were talking about. B, the market didn't deliver what they were talking about. And this left a lot of people very disillusioned and disappointed with the metals and this market. And I don't think that's a reasonable way to do business or to conduct yourself when you do have something to sell. It should be, here is something that provides safety for your purchasing power. And on the other side of that, we shouldn't be looking at this as a sensationalist or fear-based way of trying to sell metals. I fundamentally disagree with trying to do that. And so that's why, I've been very appreciative of your approach over the years.
Yeah, and it's difficult. I don't get the following, or I don't get the accolades, for example, with multitude of different podcasters bringing me on, because I'm not a big showman in terms of speculation and conspiracy. I try to read the markets and allow the tea leaves and the breadcrumbs to kind of tell me where things are headed, versus this 10,000 foot view that, yes, we all know the government's in debt. We all know that a fiat currency never lasts over a long period of time. We know that they have to inflate or die. Those are great backstories, but to use those as the mantra of saying, listen, gold's going to go to an equivalent of $32,000 an ounce, and therefore, go ahead and you need to buy, and without really the client understanding how much actually paying for the metals or even what metals are getting, they may not realize, hey, at $32,000 an ounce, we don't even have a republic anymore. I mean, or the environment of which to own, for example, which at $32,000 an ounce, you may have massive counterparty and systemic risk. Now, and this takes you into another realm within the industry, being that it's unregulated, is the industry where people are maybe storing metals at depositories, or they have structured programs where they're storing it at through a dealer, and the dealer's storing it with a depository. So that I call that a master sub relationship, where the client has no interaction with the depository, but they have to go through the dealer to do anything. They're now beholden to the dealer's pricing, for example, but also if they want the metal, they have to go through the dealer, kind of like the authorized participant sort of scenario. But the idea, though, is these contracts are written in such a way that limits liability. They have hold harmless agreements in them. They have waiver of jury trial clauses. They have waiver of class action clauses built into them. That you see the reduction of liability of these sponsors of these programs and so forth, and it's benefiting the sponsor unfortunately at the expense of the consumer. And the consumer most of the time doesn't even read the contract. And I've talked to a lot of very wealthy people, a lot of smart people out there that never read their contract. They just basically signed, it's kind of like, I guess it's like a cell phone. When you open up a cell phone and you have that, terms and conditions, who's going to read, the 50 million lines of contractual obligations and terms and conditions? No one does. They just click on it. And I get that. It's, people are trusting. Problem is, you're dealing with an industry that is leveraged. You're dealing with participants. Most depositories, for example, are owned by gold dealers or affiliated with gold dealers, banks, financial institutions, or cash in transit companies. And so those instances, those companies or depositors are really a part of a larger organization as dependent upon transactional revenue as a revenue model and income model, not the storage side of their business. And so if the dealer, for example, gets into trouble, all of a sudden, how much risk does that start to weigh on the depository side? And we've seen this unfortunately happen where dealers have, embezzled money from the depository sister company, for example, First State Depository, one of the largest failures in depository history in the United States. I think it was CFTC. I think it was $115 million in precious metals were lost. You've had dealers in the past. You've had programs in the past that went under. There has been more destruction, I think, immediately to people's personal wealth through a lot of these embezzlements and frauds and overcharging premiums and so forth, then I think the detriment of spoofing prices, that over time those prices have risen up and sort of, I think, made people somewhat, it kind of bailed them out. And what you're seeing right now is the industry, this is the structure of the industry. And this is why I try to promote and educate and say, you got to read your agreements. Most people don't realize a lot of these popular programs, even these allocated or pooled programs, are just securities. They promote this idea that you own metal, but in reality, you don't own metal. You own a digital representation of that physical metal, or you own a promise of that physical metal that's being stored in the vault. But there's not really a specific bar that or coin or that's in your name. And then that's trying to educate people to that as we see the markets becoming more volatile. If gold goes to $15,000 an ounce, or these promoters are right, and you have a breakdown in the dollar, you have a breakdown in society, rules are go out the window, fascism kicks in, all of a sudden you have capital controls everywhere. You need to know how you're going to get to that metal, how much access you have to it, what that counterparty, what the risk is that counterparty has, the going concern risk that counterparty has. There's a lot into this environment that starts to get factored very quickly if the market starts to get very, very volatile.
Bob, something I heard you kind of mention in there, and this is in my notes to ask you as well, is how does silver possibly create, and especially the silver short situation, possibly create a systemic issue for the banking or the monetary system?
Well, silver itself is very small compared to the overall banking system, so it's just one smaller faction of it. I think it's more of a confidence of maybe viewed as it's funny because I put out today, there's an interview by with Jim Cramer, I think it was CNN, and it was talking about him recommending gold. I think it was last year last year or the year before at Costco, buying gold Costco or buying gold from Costco. But I think it was in the 20 to 25 second time slot. He goes, I'm not really interested. I don't really think much about silver, which is actually probably a good sign. But I think it's a confidence play on the system itself. And typically gold and silver are sort of a barometer of fear that people are having with, or concern that they're having with the financial system, with systemic issues, with the devaluation of currency, the economy, uncertainty, those types of things. That's a barometer. And I think that's one of the reasons why I do agree with some of the individuals out there when they talk about manipulation from a very large perspective. Yes, the government has every interest to make sure gold doesn't go up through the stratosphere, because obviously it would start to set a tone against its own currency that there's trouble there. And you saw this in the 1990s. You had the strong dollar policy by President Clinton and Treasury Secretary Rubin promoting the dollar. And at the same time, gold basically was held into check. So you can make this inference that there was a benefit to talking up the currency, because therefore that currency could be used to increase the economy, in terms of investment, not only in the United States, but outside the United States, selling treasury debt outside the United States. It promotes a favorable element to U.S. assets, which gold is a more of a neutral reserve asset. And when gold starts to rise, and like we've seen, and central banks are buying gold, there is a concern that starts building of like, okay, wait a second, is the treasury pristine collateral anymore? And then you have that, that of course, that's why I think the stable coins were put out to try to extend the issuance of treasuries and the financing of U.S. government debt globally through maybe more retail channels. But to me, that's some of the things where I think, like for example, the silver market and the banking system, that's where I think some of that light can be shined on. I don't think the banks are just naked short silver contracts because from an accounting perspective, knowing the industry, it would be too easy to you'd start to see dislocations come apart everywhere. Whereas I think, especially when banks have made so much money with the rise in the price, it would be telling me they're making more money on the spreads and financing this market and sort of being the one who sells, like in the California gold rush, it was the guys that sold the picks and shovels that made most of the money, not the people that were looking for the gold. Yes, you had some outliers, but I think the banks are the ones that provide that capital that make money on the spreads and the markups and commissions and things like that. To them, it's just business.
Mm-hmm. There was a reply here from Sir Silver Quack talking about the leverage ratio. So he's talking about over 200 paper ounces traded for every real one, and how that is a systemic risk.
It's actually, that's a kind of a misnomer. It was, I think, and this is one of the reasons when I said the market has delevered considerably from where it was in 2008 to 2011. Back then you had not as much metal sitting in COMEX depositories, and you had more open interest relative to that metal. So you did have a much greater paper to physical positioning, I guess you could say. But if you look at, for example, and I posted this numerous times, I just have to pull it up real quick. If you look at the open interest relative to the ounces being held in the registered categories of silver and gold, I think it's almost like a 2-to-1 ratio on gold, two or somewhere right around there, 2 or 3-to-1, and I think on silver it was like 6-to-1, something like that. The leverage play is not nearly as great. Now, yes, on a day-to-day basis, that's open interest to actual physical metals back in those contracts. Yes, on a daily basis, the trading volume is very great relative to the actual physical metal, and that's been talked about, and even I've put that out there, where you're talking billions of dollars a day of paper metal being bought and sold, especially in the contract for differences markets in Europe, where the CFDs, the contract for differences, is not even allowed to be traded in the United States. It's actually banned because it's somewhat of an unregulated, highly levered type of contract that's more on the over-the-counter market, where you don't know who the actual counterparty is that you're trading against, and you're dealing with a lot of leverage. But yes, in that market, there's a lot more paper volume being traded, but you have to remember those people that are trading have no interest in actual taking delivery. They're just interested in the price action and the price representation. I think you're on mute, Tom.
Sorry about that, guys. You wrote a bit of an analogy or an impression of Grok explaining the structure of the shorts in the silver market right now. Can you review that for our listeners here?
Yeah, maybe it's my dry sense of humor. I kind of looked at it as you try to create analogies when you're dealing with finance, because I know a lot of the stuff I put out there, a lot of people say, my God, I need a decoder ring just to see what the hell you're talking about, Bob. I have no clue. And so I try to put this analogy on there. If you're short the market, for example, and the market's being pressed against you, and you're trying to get out, but every day the market's closing at the highs of the day, not letting you out. And it becomes this sort of almost this wedge or wedgie that that's just exerting more pressure in the wrong direction, making you more uncomfortable. And the more you try to fight it, thinking, okay, it's going to go down tomorrow, the tighter that pressure becomes, or the friction becomes. And that's what I tried to instill with a short squeeze, is that you have this unique set of events that have been unfolding, which I've been trying to capture on a daily basis for the last number of years, and trying to do it very accurately, where I'm painting this picture and the structure pushing the market in one direction. And you're seeing the culmination of that, where players now, it's not just guys that are short that have been betting against the metals. It could be people that, like you said, that or that are hedged, and for example, miners that are hedged their production, and their hedges now are kind of blowing up in their face, and they're getting margin calls on their short side, even though their underlying physical inventory or their underlying production is going up in price. They have hedged and locked in maybe a profit already, that now that hedge is becoming more of a negative factor on their books. And you saw that with Barrick, so for example, back in the 2000s, where they took a massive loss because of their hedge book, and a lot of mining companies reduced or stopped hedging because of that, because of the damage that was done to their balance sheets. What I'm saying is that the short positions can come from anywhere. It could come from players, clearing firms, for example, or it could come from players that are fabricators that, for example, or dealers, wholesalers, for example, this summer, where they're sitting on inventory, the prices are going up, the inventory isn't moving, people are selling more, they're hedging more, it's costing them more of a cost of capital to borrow, to short more futures contracts, for example, to hedge their underlying physical inventory that they're paying interest on as well, through their lines of credit. But these are things that, these are all parts of the market. The precious metals markets are actually a fairly vast and much larger scale than I think most people imagine. The pricing points and the inputs and outputs that affect daily trading on every day.
Mm-hmm. Well, let's maybe get Jim Hunter in here, if you wouldn't mind, Jim. Let's give us an update on the futures markets and how much trading and let's say any developments in behavior that you've seen over the last little while.
Hi, Tom. Thank you very much for having me. Hi, Bob. Nice to listen to you again. I'd like to maybe just go over a couple of things that Bob didn't touch on. And first of all, if I just look at, or if the people that are listening in the room today look at today's trade action, typically gold and silver trade the same direction. And you can't bet on it. You can't say that it's with 100% certainty. But today specifically didn't. Today, gold had an outstanding day early in the day. And actually, today's trading started last night at 6 o'clock Eastern time. And we hit like $4,000.50 last night. And today's high is $4,014 in the gold. And when they went out at 5 o'clock today, they're at $4,007. That's up $31 per contract, $31 per ounce per contract on the gold. And if you contrast that with silver today, silver actually traded lower. It had an up day for a while, but at the end of the day at 5 o'clock, we're down 79 cents in the December contract, 47.65. Mm-hmm. I watched some of the equities, some of the minor equities, and a lot of the minor equities, gold included, sold off today. And why is that? Well, I don't know for certain, but it might be because they've had a fantastic year-to-date performance, and people might be taking some profits. One thing that Bob didn't cover that I know he's aware of and that would be why. Why has gold had almost double since January of 2024? Gold went from $2,100 to $4,000 today. Some big traders in the world, gold and silver are worldwide markets. I look at the New York variant, COMEX silver, COMEX gold. I will offer that I retired last December as a professional broker. So I'm out, but still avidly watching.
Congrats.
Gold is been the beneficiary of foreign central banks that are using the underlying metal, either the physical metal, which they're buying, or they're using futures contracts to protect themselves against a U.S. dollar initiative or something that could happen in the U.S. dollar. What can happen in the U.S. dollar? Well, gold has gone in a year and 3 quarters. Gold has gone from $2,000 an ounce. That's 1 ounce of gold priced in dollars to $4,000 an ounce. If you look at that gold eagle on your desk, that same gold eagle a year and 3 quarters ago was half price in U.S. dollars. So what has happened? Well, some foreign central banks that can print their own currency have voted to buy gold with it, maybe in choice of United States Treasury bonds, which is a U.S. safe. Some people say safe or risk-free holding. It's not. U.S. Treasury bonds can go down in value. They can also go up in value, depending on the rate of interest in the marketplace. So Bob is well aware of it. He covers it, different things on his Twitter page, on his X page. But it's my opinion that the world is deciding that the US dollar might not be so safe, such a safe haven in the last 12, 15, 18 months as it was, a year and a half ago. So the price of gold has gone up. What I'd like to ask Bob, on a scale of 1 to 10, how he views the United States public through his organization on a 1 to 10. With 10, they're buying like crazy, and with 1, they're buying minimal or not at all on both gold and silver. Could you help me with that, Bob, quickly?
Yeah, I mean, I talked to a lot in the industry, and it was good to hear you, Jim. I think earlier this year or even in the summer, you probably can make the inference that it was probably 70-30 selling to buying, or even 80-20. I think just recently, really since Labor Day, I think that's shifted to maybe 80-20, 70-30, that type of mix on the buy side, from an industry perspective, which that's where you're trying to gauge, to me in the markets, that's helping me try to gauge, okay, premiums. It's, because we've seen a lift in some premiums, but you're trying to gauge spreads. You're trying to gauge, okay, not only where the metal is headed price wise, but also pricing for the products and what to expect for the customer going forward. I mean, some of this have been, which people that are listening may not be fully aware of, but September, October timeframe tends to be, you're going into sort of a retooling amongst the sovereign mints. For example, the ones that make, the sovereign coins, eagles, maples, whatever it may be. But they tend to do the crossover where they go from making a 2025 to now starting to make the 2026 year. So there's redying and tooling that needs to be done, maintenance that needs to be done. It typically will shut down for a couple of weeks and do that. So you have these oddities where you get this sort of pricing disparity that kind of kicks in during this time frame, which is just the natural ebb and flow of crossover of years, for example, which most people may not be aware of. And again, like I mentioned earlier, the US Mint had shut down for 2 weeks and was not taking orders as they were going through their audits and so forth. So that created this sort of artificial tightness that kind of sprung onto the marketplace. And that's where I think in our world of precious metals, also when prices start to go up, that tends to sort of get people's juices going. And they're like, okay, something's going on in the world, or something's going on in the U.S., or I mean, there's always stuff going on in politics, but it tends to get accentuated when, or maybe more focused on when the price of gold's going up. And oddly enough, I don't think I've ever seen a time frame where gold is just going right through the roof and the stock market's going along with it. I mean, this is a very odd time. Typically, these are uncorrelated assets over time. They don't necessarily hit all-time highs together. So I think that's also kind of questioning people of like, oh, okay, where do I put my money? Is the stock market right? Is the gold market right? So I think these are great questions that people are having. It's just now and the banks are obviously now getting into the fray because they've been issuing a lot of structured products this last couple of years in the precious metals world, as well as in alternative assets. So you have, the banks are increasing their price targets, and typically you see the banks on their dealer side, when they take inventory, when they start to distribute that inventory, they need a markup in the prices and a markup in people's interest for that product to start to take hold. And they typically will start selling their inventory into a rising environment. And so, that's something I tend to see, in the course of history over my career is, banks unloading inventory into a rising environment. And it's one of the reasons why, the public is like, well, God, why do I always buy high and sell low? Well, there's a reason for it. And and Wall Street has a habit of creating, putting lipstick on the pig, so to speak, on whatever asset they're trying to get rid of to make it look as great as it can. And I think you're seeing a lot of the AI is something that I think a lot of very astute, smart people on X have been calling out on and trying to say, wait a second, this doesn't sound right. You're seeing that type of questioning of asset appreciation out there, and it's leading people to alternative assets like gold and silver, and the price is obviously helping that conviction.
My reasoning in asking you the question, Bob, was that try to gauge a little bit of sentiment from your professional opinion in your business. And it does not sound like to me that you're stressing over everybody hauling or piling into gold or piling into silver that may be more indicative of a topping action. Is that correct? That's not the way I'm reading what you're saying.
Yeah, well, there's been a lot of capital flow coming into the sector. It's not your traditional, when you say retail products.
Correct. Retail buyers.
Yeah, retail buyers really aren't the market. They don't really press the market prices per se, the spot prices. They're more of they're long for the ride, so to speak, which it's something I kind of spoke out on in 2021 during the silver squeeze when a lot of the dealers were saying, let's all buy rounds together. We're going to, disrupt JP Morgan. But in reality, what was happening was it's like trying to buying 2x4s at Home Depot and trying to take control over the lumber market.
Sure.
You're just never going to do that.
Right.
So the issue is the capital flow from hedge funds and mutual funds and portfolio managers and the public and the high net worth investors. A lot of that has been shoved into mining companies and ETFs and other structured vehicles, more so, for example, than the coin and bar market. That's a very small market overall compared to these paper instruments. And in that realm, you're seeing mining stocks I think they're vastly overbought in terms of from a technical standpoint. I mean, you're talking GDX and GDXJ, for example. I think it's 7 weeks now on the weekly chart. It's 7 weekly periods above the upper Bollinger Band line. That's unheard of. I mean, you have the bullish percentile gold miners index sitting at 100. It's been stuck at 100 for since the summer. I mean, it's just a massive run. And I congratulate everyone who's been in it. I mean, it's just been tremendous. But these types of runs, when they go vertical like this, you have to be looking at, not just the fundamentals, but you have to be looking forward to say, listen, if the general market has a hiccup, or what if inflation starts to take hold and energy prices start to go up and the input costs of all these mining companies start to rise, because they've had sort of a perfect world with the cost of production kind of lagging versus the acceleration of the price of the underlying product that they're pulling out of the ground. But now that you're starting to see these big mining companies come out with their numbers, their cost of productions are starting to rise. And if oil starts to go up, that's going to be a huge input cost that has not been evaluated in the gross profit margin, not necessarily on the spot price of the metal, but when you take into account the costs of the miners. So those are things that people want to be watchful for, because typically mining stocks typically are a great trade, but they're not necessarily always the greatest long-term investment. So you just want to be aware of that. And obviously we're very from a sentiment standpoint, very, very bullish. I mean, it's hard to see anything on X that's negative gold and silver from anybody who's posting. I mean, it's totally opposite of what it was in early 2024. You couldn't see there may be one positive post for every 9 negative posts out there, and people were just completely distraught, saying, "My God, the cryptos are the only place to go to." And now you're seeing the exact opposite, where Jim Cramer's talking about buying gold from Costco. So you want to be somewhat aware of the market, but that's, again, you're looking at different types of vehicles when you're looking at mining stocks versus physical metal.
Well, I'm glad that the prices have, I guess I say, exploded in gold in the last 15, 18 months when you double prices. And you didn't double prices from 800 to 1600. I mean, these are prices that people would have only dreamt about a year or two ago at $4,000. And as Bob mentioned, there's some of these banks, some of these professional banks that are in the business are talking about over $4,000 gold in the next 12, 15, 18 months, as much as some are saying $5,000 now at some point like that. So it's exciting, and it's exciting for me to watch. I hope that the people in the room that are listening are getting their share of either physical metal. I think everybody should have physical metal. Physical silver, especially. Silver is lagging, in my opinion, and silver's got a ways to go. With $4,000 gold, $50 silver is cheap, in my opinion.
Yeah, and not only that, like you mentioned the banks. I mean, Goldman Sachs came out, what was it, last night or this morning, talking about upping their price target to 4,900 from 4,400 gold. I mean, so yeah, you have a confluence of events happening where the banks, who, the manipulation crowd say they're the ones who are suppressing the price, they've been actually some of the biggest buyers the last couple of years, and actually getting people into the space, been actually very constructively positive. So that, again, but you're watching this market change over time, and how it reacts to events in the world, how it reacts to the structure and leverage within the system itself. This is part of the overall game.
Tom, can I ask a question to you, please?
Of course.
Bob has been very generous with his time in these spaces and on Twitter. Is it okay for me to mention to people in the room that they can view Bob on his Twitter handle and see his website there? Is it okay to mention that or not?
Yeah, of course. Profits Plus Idaho. I think everybody's pretty familiar with Bob, but of course it is.
I appreciate it.
One thing I'd like to just mention too is that Bob's got a family business, in that, heaven forbid, he would get hit by a bus and he's in the hospital tied up. He has his family that help him run his organization. So he's got continuation, in case of a tragedy or an emergency, that his business will be ongoing.
Yeah, it's very tight.
A good point, Jim.
Yeah, it's a very tight business that we run. We've never had a loss at the facility. Yeah, it's the care that I've had, as most people may not be aware of. I've been a registered investment advisor since 1992. I've never had a client complain on my record. I mean, I try to be as honest and as informative for the client. I tell people I'm not a salesman, but I will provide as much information you need so it can help you make that decision that's best for you. That, to me, that's building a relationship, and that's what it's all about. It's not using the fearmonger ploy of, hey, listen, I got these bars and they're made by this refiner, and that refiner's not going to make any more product for the next 2 months, and if you want it, I have plenty of it. I mean, those aren't the ploys that I like to see, and I see that a lot, unfortunately, that type of advertising and marketing, that I think it may be successful in generating revenue and sales, but ultimately, the client doesn't maybe buy it for the right purpose. And then when you get volatility and the prices go down, they start to question, okay, why did I buy this? What was the story behind it? And I see that all too often.
Mm-hmm.
Tom, can I ask you a question, please?
Give me 1 sec here, Jim. We're going to open it up to questions. So anybody that has a question or would like to say something, just request to speak, and we'll move to some listener questions next. Go ahead, Jim.
Tom, you've recently, and through your broadcast career with your former platform, you've interviewed a lot of, I guess, industry stalwarts, big names. Mm-hmm. And can I ask, please, from your personal opinion right now, are you thinking that gold and silver are topping out, or are you a little friendly, or are you very friendly at this point? Your own personal opinion. I don't care what your positions are, but just your opinion from your background, from all these experts you visited with.
I tend to look at all of this far more as a long-term thing, Jim. I'm not worried about the next month or the next 6 weeks or the next week kind of thing. I don't want to have to manage my emotions trading. I don't want to have to manage, all these kinds of things. So I don't see them topping. I'm happy to ride out the volatility with the positions that I have. And that's my, let's say, strategy towards it. I do hold some mining equities. That's a little bit of a different story. There's going to be a time, to sell that stuff. There's going to be a time to sell physical as well at some point. But I think we're a ways away from that. From all indications, the idea that that these fiat currencies that the metals are measured in are only going to continue being printed at this point. I don't see, a big change in that trajectory. So at this point, I'm happy to hold my metals, to hold the other positions that I have, and I'm happy also to ride out volatility that is inherent in markets as they unfold.
Thank you very much for your opinion.
No problem, Jim. I think we don't really have many questions here. So, Bob, if there's anything that you'd like to wrap up with or leave our listeners with, we can do that.
Yeah, I think there was. It looks like someone had requested. I don't know if
I approved them and then they disappeared.
Oh, okay. It looked like someone else had requested something too, but
looks like a shady account.
Oh, okay. Yeah. No. Again, this is. Again, I look at it from a long-term perspective, like Tom does. Whenever I post something, yes, it's great to be, great. I mean, it's nice to be right, very short term. But again, focusing on the physical metal is really what I try to do. The story is going to play out over time. This isn't something that's just going to be a one and done. And I think with silver, I think there's more to go. But there's a ebb and flow that I try to catch, if I can on a day-to-day basis or a weekly basis of, the how participants are stacking up, whether on the buy side or sell side, or, if there's pressure on one or the other sides, trying to focus on and provide that information. I know some people trade on what I put out. That's great. I try not to, again, what I put out is not investment advice. I just try to help people understand, there is some rhyme and reason to this whole market. You just have to understand how the system kind of works.
DK, do you have a question? All right. Ilni, do you have a question?
Hey guys, Bob, thanks for doing this. I know you touched on this a little bit with, the SLV, the non-physical ETFs like SLV and GLD. But let's say that there's a financial dislocation, on the order of like 2009, and silver and gold prices rise significantly. I think JP Morgan puts out a bar report every night for, the two ETFs. Assuming that I have it in a cash segregated account and my broker is good and I haven't lent the shares out, what's my counterparty risk if gold goes up, significantly overnight and there's a dislocation in the system? Does the ETF actually own those bars and actually have a claim on them? And are they actually in JP Morgan's vault, or what is going on there?
Yeah, I mean, those are good questions. One thing, the bar list that you see, the share count that you see every afternoon when it gets put out is different from the bar list, because the bar list, actually the metal is delivered the next day, I think by 9:00 in London time. And so you'll see the bar list updated the day after the share creation report a redemption report comes out, or I should say shares outstanding. If you have a dislocation, the ETFs it would be absolute fraud if they didn't have the gold. I mean, or the metal, the silver. They are audited, and they have been found to have the metal. And that's the only way contractually they can actually issue shares is by the physical product being delivered by the authorized participant, and then the shares are created. There's a multitude of different ways, though, that you could have risk in the ETFs. But we did a full, I think Tom and I did a full like half-hour summary of the ETF world. But a couple of the different risks out there is, one is, what if the markets get shut down? I mean, if you have that big of a dislocation, like when 9/11 happened and, the markets were shut down for a full week, you had no liquidity into that. And so the price disparity of the prices going up or down, you couldn't actually take advantage of that. Whereas the physical world was still active. There's a lot of different risks. If they can't find the product or the bars to actually deliver into, and you have a mad rush of people buying, the ETF in theory could go to a very sharp premium to net asset value, which then at that point, if you're buying the ETF and you're unaware of that very fat premium, now you have a spread risk that premium could collapse back down if things ever normalize. Another thing too is when JP Morgan custodians the metal, if they sub out that custodianship to a sub-custodian and that sub-custodian loses the metal, for example, JP Morgan has no recourse to that sub-custodian. That's London law. And of course, the ETF holder has no recourse whatsoever to the sponsor. That's built into the prospectus. So there's structural events that can happen within London that are completely outside the control over the investor, even outside the control of the authorized participant or even the sponsor itself, that does lend potential risk disclosures that, of course, they're listed in the prospectus, but those are just a couple of them that could actually create issues. And then, of course, the other thing is liquidity, the authorized participant's inability. For example, you have a market dislocation or crash, authorized participant, their lines of credit are cut, or they don't have the capital flow to provide liquidity to the ETFs that they're making markets for. Because it's not just SLV that, these firms are making markets for. There's a slew of different SLVs and strategies that these things that they're participating in. So the capital flow, inability to provide liquidity, could also lock up or create dislocations within the ETF pricing relative to net asset value.
Got it. Thanks, Bob. Yeah, that City of London risk is pretty interesting. I'll have to do some more research on that. Thanks.
Yeah. And a lot of people will point to Sprott as the savior for a fund that owns physical, but Sprott, the PSLV, has issues within itself that are different from SLV, and those things, we could get into that. But there are concerns and risks that are presented with PSLV that if you get into a dislocation, people are not aware that the Royal Canadian Mint is a private crown corporation. The Canadian government could come in and privatize that entire facility and take all the metal they want. That was an actual risk disclosure that was mentioned in the Royal Canadian Mint ETF, gold ETF, that was put out, I think, in 2011. That was one of the risk disclosures that they actually had. Not many people actually understand that. And of course, the sponsor of these funds that store there are not going to market that as well. But there are differences in structure of a closed-end fund versus an ETF as well.
But inherent in that, Bob, the Canadian government would have to actually value gold and silver, but they've sold all of theirs. So
that's what makes it. That's why that becomes a bigger risk.
Exactly.
They don't have any. Yeah, I mean, that's what, again, as precious metal owners, we go, $15,000 gold, woohoo! We're getting rich, but there's a reason why gold's at that price, and it's not because of rainbow and unicorns. I mean, it is literally, you're having a massive degree of increase in risk and friction within the system, and what you're trying to do at that point is reduce your counterparty exposure, not add to it. And that's again why I try to promote physical metals held directly, whether it's a depository, you have a direct relationship with that depository. But if you're getting into structured products, you're getting into some of these other types of very popular programs, blockchain, or these I call them balance sheet financing operations, where you're supposedly are marketed that you own gold or silver, but in reality you own a promise, not necessarily a physical bar, and then that organization can use that metal under their own discretion, for example, for financing inventory or taking advantage of market arbitrage, whatever it may be. They're using that metal without paying you any interest. Those are things that the public should be aware of, but it's not discussed enough, unfortunately. And I know pooled programs are another issue out there where people store in these pooled accounts at refiners and so forth, and they don't charge any storage fees. But in reality, it's just using that metal for the balance sheet operation of that refiner.
Montana native, do you have a question? Got to unmute yourself. There you go.
Yeah, I was just, thanks for everything, guys. I appreciate it. Concerning central banks and how they've just been piling up the gold the last few years, you're looking at Saudi Arabia buying SLV, historic mineral stockpiles. What do you think the chances are that some of the central banks, either secretly or out front, just start stockpiling silver? And I'll just leave.
Yeah, I mean that's something that people are talking about, but it would take an immense amount of space to do that. It would be easier just to revalue gold higher, honestly. And not only that, you're talking about a size of a market that's much deeper than the silver market. It'd be nice if they stepped into that world, and maybe we get to a point where you have, maybe it's the government that maybe start to look at using silver again from a monetary standpoint. But I think the silver market is just too small, or I don't know if central banks would want to compete with industry, because silver is such a much needed material for so many different products and processes out there, especially if we get into this silver battery situation. That could obviously create a whole new wave of demand for industrial demand for silver that you may not need the central banks to come into the picture. Of course, maybe that's why Bitcoin was created.
Don't open that rabbit hole, Bob.
We've gone down that where 4 hours later we're like, oh my God, I got a headache.
Yeah, there's certain spaces that have gotten really out of hand on the Bitcoin bit, but it's okay. Anybody else want to ask a question before we wrap up here? Bob, I think this was really useful. I always appreciate your time. I always appreciate getting to chat with you. And I mean, this stuff, the ins and outs of this stuff extremely well, extremely thoroughly. And, I think these kind of conversations are always useful, because I don't always ask the right questions, even though I try to. And I appreciate everybody that participated today and came in and asked questions, and especially Jim and Bob. That was excellent.
I was going to mention, Tom, just now that you've kind of gone on your own, maybe you can kind of shed a little bit of light on, because where the direction of, what you're going to take your new sort of media company, what you're looking to do versus obviously what you were doing before. Is it going to be somewhat similar, or is there other types of avenues that you want to try and maybe bring to light or focus on?
Definitely. I feel like I have obviously more of a blank slate to work with here. Originally, I had started the Competent Man channel to be able to just have some discussions outside of just gold and silver kind of thing that I was doing before. I've done a lot of very different things in my life that I think people can get a lot of value from. I'm doing these things anyway. I've built a lot of things. I don't necessarily have a background in communication or finance or anything like that, but I've learned a lot of these these subjects, and I want to be able to help provide people with a platform that, in a way, broadens their horizons. And so, as much as one day I'll tell the story about what happened, I guess, but that day is not today. And at this point, I'm happy that I have the support of a lot of people, both in the professional realm and also from all of the listeners that have followed me so far. I'm extremely, extremely grateful and humbled by that. So to get back to your question, Bob, absolutely. There's a lot of stuff that I have kind of in the works that I'm going to be working on. Obviously, now that I'm doing this on my own, I am going to have to monetize this at some point, and there will probably be some stuff behind a paywall, but I want to make sure that provides enough value or more value than what people are paying for it. Yeah, I mean, I'm really excited. I'm very grateful for everybody that did follow me to the new channel, and I'm really looking forward to this new chapter for sure. Questioning Mind, did you have something to say?
Yeah, first off, just to say that I really appreciate Bob and his very, I'd say, truthful and cordial sense in trying to give each individual an opportunity to understand what really makes the market for especially the physical precious metals. I found that very insightful. And Tom, secondarily, I think you're a great interviewer. I think you give very kind of fresh information to your audience and in a way that's very formal as well as kind of insightful and prescient. That being said, one thing I wanted to add was, and this is a bit provocative, although that's kind of how I am, trying to understand what other people's thoughts are and trying to kind of bounce ideas off each other. But I got to call out, Steve St. Angelo and kind of what he's acknowledged as well regarding silver. And the prior question related specifically to silver, but one of the counterpoints to that, which is a bit interesting, is because of energy dynamic, silver may be more difficult to mine. And the reason why I'm saying this is that many different miners of non-precious metals have like an additive bonus of silver as something that kind of supports their mining framework. And in the future, as energy costs increase, there will be an equilibrium, or I would say something. So it'll go from a leverage side of a downside to silver price to a leverage side of upside, because energy is going to become more difficult to acquire. That's as energy efficient as oil. So I'm just kind of curious, Bob, to kind of hear your thoughts, or Tom, if you have any other thoughts on that and how that interacts, I guess, with the banking system and how silver is priced in the future. Thanks.
Yeah, I agree with Steve. Yeah, Steve and I have developed a very good relationship over the past few years, and I've kind of got to see, he has an interesting story that he looks at that not a lot of people look at when it comes to the energy side, which I was not even aware of some of the stuff that he kind of digs into, but he really, his analysis is second to none. I mean, whether it's reviewing a balance sheet, understanding the cost of production, but I think you're right. Silver, just was labeled as a critical metal, which, just that's the first time that's ever happened. I mean, that has to tell you that, we are seeing silver much more than maybe in the past, and it's not just the U.S. There's a lot of countries that are probably looking to acquire stockpiles for some future use, and that's why, whether it's this battery that's been talked about or something else out there or solar or whatever it may be, that can be very explosive at a time where if energy is shifting to, like with solar and so forth, you need And the silver battery thing is actually real. And in order to scale up, you're going to need an immense amount of silver to do it. I mean, you got to store the power, not just create it. Yeah, because that's actually pretty critical too. So I think you're right. I think, again, that's why I look at silver from a longer term standpoint. Yes, the hedge fund, just to give people full disclosure, I'm basically 99.5% or so invested in, or 99% invested in physical metals held outside the financial system. 72% of the fund is roughly silver. It was about 15% or so is gold, and about 3% is platinum. But there are times to maybe reduce exposure on a big price spike, for example, with silver. I mean, it is a volatile metal. It's not just something that it just goes straight up. But I think the longer term, for people that are invested in the story, I don't think you've seen. I think that you're right. The cost of production is rising, and it's rising as you see it with gold. And I think silver has been playing this laggard, like you were mentioning. It is a byproduct of other mining, and you're seeing these other mines now, like with copper. So the second largest copper miner in the world go into force majeure, and you're seeing these sort of the friction and some of the challenges that the mining industry is having on the base metal side, as countries are trying to print their way out or use economic warfare. I mean, there's only so much of this stuff out there. And I think silver is kind of positioned interestingly, because from a primary standpoint, was it only about 25 or 30% of the silver that's mined is mined from a primary standpoint? But yes, I think you're going to start seeing that cost of production rise, which will be very supportive as a floor for the price going forward.
Yeah, and just to add on top of that, I mean, the way this really kind of, I guess, interjects with some of the topics that have been said today. So one, we've talked about kind of collateral and what precious metals offer, right? And the reason why they offer collateral is because they're energy intense. It takes a lot of energy to produce them. And it's an understanding of natural law. And that's kind of how I think. And that it takes real work to actually create them. There's also a leveraging silver, and I've already kind of discussed this about energy production. And so that leverage will only increase as it relates to silver, because the byproduct will reduce as energy costs rise. And then, of course, we live in this new technology age, which continues to increase. That's kind of how I'm saying this, is that you see this expansion of data centers as well as other technologies. In my opinion, it seems a bit asinine. I don't see a whole lot of profit, at least currently, with a lot of this expansion in AI. It's great to see that South Park, you can create brand new episodes of South Park in the future if you want to as an individual. Saw that recently based off of AI. And then I guess the third point I'd just say is that, or the fourth point is that, silver can't be replaced. I mean, you look, all over, you try to differentiate ways in which you can replace a specific product for technology. And I think it's something that just offers so much potential, that an opportunity, that it's not something that's easily replicated. And so with that, I'm kind of playing devil's advocate here in some respects, but it's a way to offer optionality to the future of someone's portfolio in many ways. So the way I kind of see it as it's almost like a diversifier of the future in a way that is almost an optionality diversifier, if that makes sense. So it's not just a precious metal in the sense of bank collateral or this sort of thing, but it's also kind of encountering this whole energy production scheme, this technology scheme, as well as a scheme in relation to the way by which silver can't be replaced. And I'm sure I'm leaving other components out relative to silver, but it is truly something that is differentiated amongst, I would say, many commodities.
I would agree with that, but that doesn't absolutely mean that it has to go to, let's say, $100 or, a particular price point. The more that silver gets used in a lot of ways, the more it gets seen as an industrial commodity, right? And so you made a bunch of excellent points, but that doesn't necessarily mean that it gets reflected in major revaluation as well, right?
Yeah, absolutely. There's always going to be speculation on this. The way I tend to think is in terms of pressure and natural law. Like, and what I mean by natural law is if you understand the fundamentals of physics and energy and the way the world operates, then you have an ability to form opinions that are substantiated by what is reality, right? Mm-hmm. Whereas in many instances, like what you're seeing now with AI, there's a lot of kind of narrative around it and what it can do, but it's yet to be seen, especially in terms of profit. Whereas, a physical metal that you can hold in your hand that has many, I'd say, avenues in supporting its kind of framework in terms of how it's either mined or how it's refined, put into technology, the intrinsic, utility of it, as well as how we use it in financial framework. These are all things that we can use to support our own ideas and understanding of what silver actually is. So where I find some difficulty is, and this is kind of one of my pet peeves, is that digital technology has taken us away from the analog way in terms of how we're substantiating what is actual truth in our own reality, right? There's a digital reality and there's an actual analog physical reality. Analog reality is the fundamental truths that by which each of us live by, versus digital reality is it can be some fantastic sense that tends to distort the construct from which we live in. And it causes a whole lot of confusion, I think. And in the future, each of us are going to have to differentiate those two themes. They're going to become more and more disparate. They're going to become more and more fundamental in understanding the future. And you're going to have to determine how much energy you put in each one of those. And silver, it supports this digital framework, right? But it is an analog form of so many things that have intrinsic components to that are real. They are fundamentally real, versus the digital framework, it isn't, right? So I guess that's kind of where I'm getting at, is that the analog forms that you can justify are going to be so much more important than the digital future that is trying to be built, because there are so many flaws built into its narrative.
I get what you're saying, but that doesn't mean that we should be necessarily, let's say, ignoring the digital pieces of that puzzle, right? Like, I'm sure any one of us would be happy to go back and buy Bitcoin at 25 cents a coin or whatever it was. And whether you believe in it as a money or not, or a store of value, or whatever name you want to place on it, if you look at it as a speculation and take the, let's say, faith component out of it, we would be more than happy to accept those gains. So I think we have to, while acknowledging the analog nature of what you're saying and the value of the analog metal and the life that it provides for us at the current time, we also need to, be aware and acknowledge the value of the digital space, and the ability for us to even have this conversation at this present time. So I think I very much try to keep my mind open to the value of both of those things, instead of just, let's say, purely religious about one or the other of those asset classes, while still understanding the, let's say, the real value of the analog world going forward into, even more of a digitized age.
I am in full agreement. So I'm supportive of Bitcoin in a sense. So I have a very open mind. So fairly diversified in terms of kind of the future that we don't know. But Bitcoin has its own difficulties. That's not what this this Twitter space is probably about, but a lot of this comes back to energy. I think that's the most critical thing to think through in the future, is that energy is going to be something that will cause it'll give people an understanding of truth, because that is what provides us the ability to do what everyone does on a daily basis. And so that's one of the reasons why I brought up Steve St. Angelo as well, is because I think he does a great job in representing what this oil construct has done for civilization. Is it's basically removed. So this is a bit tangential, but it's removed slavery to a lot of extent, right? I mean, you can kind of think of yourself as, because you live off of oil or natural gas or these other commodities that are very efficient energy stores of value. They literally provide you an ability to have what were once kind of it's almost like a slave class working for you on a daily basis. And as that goes away and there's less efficiency, you're going to see a reduction in your overall ability or your standard of living, right? That's what the likely future is going to be. And so it really boils down to, how are you going to lock in the wealth that you've preserved today to carry on in the future, and how do you do that, and what is reliant on that? One thing in regard to Bitcoin that I think is important to acknowledge is that it is a debt-based system. And the reason why I say that is because the Bitcoin network relies on future energy productivity and resource consumption, right? If energy stopped tomorrow and resource consumption stopped tomorrow, Bitcoin would no longer exist, because it relies fully on a network, right? Whereas gold and silver and analog forms of money don't. And there's a very short lifespan in regard to the Bitcoin network as it relates to some of the chip systems. There's either like a three year or less lifespan for those, so they have to be replaced on a continuous basis. Whereas silver and gold don't. I mean, like I said, they're analog forms of money. They're physical. Not to say they're easy to transport. I understand that, but if you're talking about wealth preservation, just kind of think through that as well, right? It's complex, but I certainly don't have all the answers, nor does anybody. Mm-hmm. But you just need optionality. Yep.
Definitely. And I think we also have far bigger problems than our Bitcoin wallets not working if we lose all energy tomorrow, right? And to reiterate your point about the importance of energy, you can look directly at a country's basically GDP growth is directly correlated to how much energy it has. Luke Roman and I have had that conversation several times. So your point is absolutely important, and really underscores the point that without, as Doomberg says, without energy, you don't have life, right? He says that energy is life. So 100% agree with you.
Yeah, and pay attention to what the U.S. government is doing with Bitcoin, right? Why is it that they're getting so focused on all these Bitcoin mechanisms to support it, right? Mm-hmm. There's another layer of this that really gets into globalism, right? And it's talking. So you're seeing a reworking of the monetary system on a global basis. That's what's happening today. That's why gold's going up. That's why, it wouldn't surprise me if Bitcoin goes kind of nuts in the short term, because usually what happens after gold's rise is that Bitcoin follows through and it supersedes gold's previous value per ounce, meaning that I think the previous high was around 37 ounces of gold per Bitcoin. It's dropped to about 29 now, but usually what happens is Bitcoin supersedes it by a specific ounce basis. That being said, all the legislation that's going into the United States government regarding supporting Bitcoin, you have to keep in mind that is something that's relative to something that's more globally realized. And because the US is in a declining monetary system, right? They were, and they still currently are, the world reserve currency, right? The USD. That but history more or less states that that doesn't exist forever, right? And so my personal opinion is they're trying to retain that power. And how do they do that? Well, they could invest a boatload of energy and infrastructure and investment into sustaining the Bitcoin network. And if you look at where the mining firms are globally, where are they located? They're located in the United States. And look at all the Bitcoin mining firms. They're all losing money, right? Hand over fist. And why is that? Well, it's because of energy. That's why. So you have to understand what's happening. There's almost like a sacrificial, like it's almost as if the mining firms are acting as a sacrificial lamb for the sustained usage of USD in a global monetary system, right? It gets really squirrely. I don't have all the answers, but don't underestimate what governments can do, right? It's really, I think some people get a whole lot of confidence in thinking they know what the future is going to be, but governments have a whole lot of power. And again, it's a narrative power. It's not necessarily truth, and it's not never long lasting in a 100-year sense, if you will. But at some point, the analog world comes back to bite them in the butt and feeds them a whole handful of truth, right? And so that's why I kind of started my point in just acknowledging that analog information is a fundamental understanding of the real world that you yourself can understand. You can educate yourself about this, right? It's something that everybody can spend time in acknowledging and supporting themselves and giving themselves the confidence in making good decisions and not relying on false narratives. Like that's my chief concern about, I guess, the future and how, especially the United States and, of course, other global countries, and especially their citizens, think about the world and how it's going to operate in the future. You can't operate without energy.
100% agree. I appreciate that contribution. Chaos, do you have a question?
Yeah, thanks a lot, and thanks, Bob. I've seen a lot of your material on Twitter for a long time, and I always appreciate what you contribute. I just have a very quick question. I came in a little bit late, and I caught some commentary on this topic, but I'm not sure if you covered this particular question. Understanding that physical is a superior form of holding precious metals. When it comes to the ETFs that do hold physical gold or physical silver, is there a cleanest dirty shirt, so to speak, in terms of the arrangements that are typically made? I really appreciate the input that you provided on Canadian Royal Mint, for example. It never would have occurred to me. I just wonder if you're looking at a list of here's where the ETF holds their gold or holds their silver, is there one that gives you a little less of a twitch, so to speak, when you see it?
Yeah, that's
Bob, let me jump in here real quick. Chaos, just explain why you would prefer to hold an ETF over physical. Is it for liquidity? Like, what would be?
Yeah, it could be liquidity. It's also for some clients, it could be a logistical issue and just a set of headaches that they don't want to deal with, or maybe just a bridge to, hey, we're looking for a physical custodian, but in the meantime, we want to have the exposure, even if it's not something we want to necessarily have long term.
Go ahead, Bob.
Oh, yeah. I appreciate the following me and everything. The problem with the ETF structure is there are probably some that are a bit. SLV is physically backed. There's some that provide some type of redemption mechanism. It may not be the perfect type of solution. I think they try they try to provide some degree of retail interaction, I guess. The only issue, though, is you're dealing with ultimately a security first. You're not dealing with the physical asset, so you gotta kind of parse this thing apart a little bit. And when you're dealing with a security, that's of course where it's on the exchange. If it's in your brokerage account, you don't own it. You're just a beneficial owner because every security held in street name is actually the owner is seed and company, which is an LP that's actually owned by Depository Trust Clearing Corporation. I mean, if you get into the real weeds of this stuff and you say, my God, if the system actually started to break, like a 2008 scenario, there was a point in 2008 in September, for 2 weeks, you couldn't buy a gold Krugerrand literally anywhere in the world. I mean, everyone went into complete lockdown mode. Even though the price of gold went down, it was like, my God, this is it. This is the moment. And so just understanding that's why it is really difficult if you get into a real true risk on environment. Because, again, you have to look at not just the structure of the authorized participants' interaction with the ETF, but also, some are held in Switzerland, some are held in different, other different countries and so forth. Like we saw with COVID in 2020, Singapore went in complete lockdown. In fact, I was one of the first U.S. depositories that actually was storing metals over in Singapore back in 2011. This is when they still had the goods and services tax on precious metals. And I was a very big supporter of storing in Singapore. I mean, that's the only country that made sense to me. But when they went into lockdown mode in 2020, and you had if you were going to get into the country, you had to have the shot, you had to be quarantined in a hotel room for 14 days before you get into the country. That's not some place that I feel, if you're trying to put your eggs in a nest, so to speak, that's a risk that we basically got to see what would happen in a real event style situation. And that didn't give me much comfort whatsoever. I mean, I get it. Countries are going to try and control the population, capital control. They'll try to, keep, from social chaos from happening, things like that. But it's one of the reasons why I kind of ended up, maybe I'm biased, but I think Idaho is still one of the best places to store metals, because it's unlike, it used to be Switzerland, where it was actually fairly private. That privacy has been stripped from you. It's very difficult to store metals or to have some place that I always say privacy is probably the commodity that will probably that's probably going to be the most expensive commodity. But the ETFs are literally just a security at the end of the day. So you have to treat it as such. They're great trading vehicles. Don't get me wrong. SLV, you can get in and out. The turnaround costs are very minimal. Sprott products, you can trade in and out, and there's a purpose for these things. But if you're truly trying to say, listen, I'm looking at the metals from a true risk off systemic counterparty risk perspective, you almost have to try to treat it as such. And that's what I do. I mean, as an investment advisor, that's what I looked at in 2006. I mean, I had a chance to talk to Jim Rogers back then. I understood some of the pitfalls that he went under when Revco went under, and his fund, which was basically a commodities fund, but basically in paper contracts. When Revco went down, it was a big clearing firm. Fund got basically caught in that storm and was inaccessible from his management. These are realities of what can happen, and we're living in a world where everything is leveraging up, and we're in this melt up scenario, which I've always thought this would be the way this thing kind of just goes straight up, and that's what we're seeing. But when that unwinds, it's going to be chaotic. I mean, everyone's going to be looking to get out all at once at the same time. And that's where, if you're a trader, you kind of have to somehow anticipate that. But even the ETFs are going to have probably difficulty dealing with that type of environment when volatility ratios go through the roof, and all of a sudden passive turns into from an accumulation to a net seller. I don't know how you can diversify from that risk.
Bob, thanks for that answer. I really appreciate that. And
sure,
I appreciate the nuance and the details. That's all I really had. Thanks again. I really appreciate it.
Thanks for the question, Chaos. Slaughter, you got a question?
Yes, thank you for taking my question. Thank you, Tom and Bob, for this broadcast. If the dislocation arrives that we're all just considering here in this discussion, what Why would the government even allow physical gold and silver to be used as currency when they just make it illegal?
Oddly enough, and I did a lot of work on this, I've looked at the Bank Holiday Act of 1933 and all that type of stuff where they nationalized gold through executive order. But we were on a gold standard back then. I mean, they were trying to increase the money supply and try and inflate their way out of this, the depression and so forth. In this realm, today's world, everything is fiat. Everyone around the world is fiat. I mean, the central banks are trying to strengthen their balance sheets with gold. You have the government that I think gold would be, I don't think it would be looked at as a harbinger of negativity. To be honest with you, I think probably most congressmen and women don't have any fundamental understanding of gold anyway. But even if they did, all you have to do is basically, if I was the Treasury and we got into a real mess and you had a real crisis of confidence, and I've said this before, the easiest way I think that they could do is if you're going to revalue gold, you're not doing it with the purpose of, let's say we revalue it and then we got $1 billion in the Treasury general account. Now we're going to turn around and sell it and pay down some debt, or $1 trillion. That would be a total waste of time. What you need to do if you're going to use gold from a constructive standpoint is you bring in the Exchange Stabilization Fund, which governs them the ability to interact with gold, provide markets for gold, and they do it through the Fed's New York trading desk. They could actually revalue gold by basically creating a market where the U.S. government would buy. Let's say they wanted the price at $5,000 an ounce, for example. They would be the bidder at $4,900, and they'd be the one offering at $5,100, and they would try to cap the price within that range and to revalue the gold on the Treasury's books to a point where they provide that gold now provides an anchor or confidence for foreign investors of U.S. Treasuries that just don't flee the ship. I mean, this was a concept that was actually done by Jim Sinclair that was talked about in the 1970s. That's how he came up with this price target at $850 an ounce. He said, well, that $850 an ounce would be basically the equivalent of where the Treasury stash of gold would equate to the foreign ownership of U.S. Treasuries. Now, you'd have to go a lot higher right now on gold in order to match that type of calculation. But that's one way you could actually, as the government, use gold on a constructive basis and try to, because if the government is successful in revaluing gold higher and maintaining it on the balance sheet and providing confidence to the country, there'd be less incentive for the U.S. investor to actually want to own gold, because if the Treasury's balance sheet is stable, I'd rather use that money from a productive standpoint by building a business or garnering income from it, rather than having it sit in the metal where it's basically dormant. But right now we're in the exact opposite situation, so we got to deal with it the way we can. But that's one way. That's a positive way of actually dealing with it. Hopefully that kind of helps, if that makes sense.
Sort of, but I think they would want to use it, like you said, for the government and force us into a currency that they would produce.
Yeah, that's my concern with the digital side. It's benefiting the few. And we see it every day with these deals being done. And, I know, Jack Gamble talks about this all the time with, channel stuffing and so forth. And it's benefiting a lot of people, benefiting the few, but benefiting them greatly. I don't think that's not going to provide. Maybe they're trying to train the young generation to maybe be more accepting of the digital framework, and maybe my generation is basically the dinosaur at this point. But at the end of the day, humans are humans, and human behavior tends to trust what it can hold in its hand. That's been at least since the beginning of time. Maybe this time it's different for the digital world, but I think all it takes is the bubble bursting, and once the melt up stops going up and starts going down, people start to realize when they take a different light when all of a sudden their assets down 50%, and they look at this stuff and they go, why the hell did I buy this stuff? the attitude can change very quickly, unfortunately.
Can I add a counterpoint?
Sure.
So in terms of like, I was thinking towards the future and repaying debt, something that, so Bob and Steve had a great conversation that happened several years ago, and it really delved into this issue, and it really reformed my ability to understand what really money is. And it's really, or I'm sorry, what debt is. And it's really the repayment of a future form of energy. That's really what it is, right? So debt has to be paid from something into the future, which is a form of energy. And assuming that energy production goes down in the future, which I'd argue is fairly certain. I could be wrong, but I have many counterpoints on that issue. It's going to be more and more difficult to repay debt, meaning that it'll be more and more difficult to issue new debt. And if the USD is based off of debt issuance, which it is, and many don't understand this, that's why if you look at an actual $1 bill, it'll say a Federal Reserve note on that, and a note means a debt issuance, right? It's a meaningful exchange to actually pay back its receipt as a form of debt. And so every future debt issuance from an actual bank is what generates future monetary supply of USD. That's how USD, or the monetary system, expands from a USD perspective, and how it grows. And so it's really a parabolic curve, right? So you have to have a continuous form of energy to repay that debt. If the energy were ever to come down, then it would collapse, right? And so that's kind of what we're moving into, which I think is an important kind of component to think through. That being said, if we're talking about a future where the current system can continue, you'd have to assume that there's some new energy source in the future that can sustain what we've created as a global monetary system, which I don't think there are any. I know many people have thought that, nuclear energy or some other forms of energy could come up, but I mean, if you look at permitting for nuclear energy, for instance, I mean, you're looking at a decade, right, of both permitting as well as building actual infrastructure. And look at the workforce of the United States. I mean, people think that, we can build a bunch of nuclear power plants all over the United States. I don't care if they're these small nuclear reactors, which have a lot of proton issues and kind of destruction of the formation of the infrastructure itself because of its the way that it's built, or the large form that's more mainstay. The individuals that knew that information have long passed, right? And so we live in a world where we are in this digital age. We've lost a lot of knowledge, in my opinion. It still exists in some extent, but I would argue that it has been lost. And it's the ability to continue energy production, right? And not just a sustaining energy production, but we're asking for something that's superior to oil, right? Which is the key here. And this all comes back to money. Money is the ability to retain energy value, right? So when that starts to erode in terms of actually supplying those specific products, you start to see a degradation in our ability to repay debt. And that's exactly what's happening. Why is silver going up? Why is gold going up? Why are there so many debt issues? Well, it's because it's an energy problem. That's what this all boils down to. And so, I mean, even like the UK. The UK is a horrible instance in terms of their electricity supply. And I feel horrible for their citizens, but I think they are they have the highest rate as it relates to electricity of any world nation, like a first world nation. And it's because they literally don't have anything to source in their country to generate energy. And they invested so much into like, these windmills and solar infrastructure and what have you that don't provide the energy value. So one thing I guess just to consider is that when you start thinking about debt, you're talking about a future tense of energy. And how do you deliver that? And how do you deliver that efficiently? The reason why we were able many years ago to repay back debt that we had previously contracted to was because energy value went up. Now it's going down. That's why the debt continues to rise. It's because we cannot pay it down because energy value isn't rising any further, right? So I don't know. It's just something I just wanted to iterate.
Yeah, it's one of the reasons why when I talk about mining companies is to understand the profit margins, because as energy starts to become more expensive, that's a huge input cost, and people tend to assimilate mining companies with owning gold, something, or gold owning silver, but those are entirely different investments when you start factoring all these input costs.
Absolutely agree.
And I mean, on one hand, I think the idea of debt isn't necessarily just tied to energy. You could also tie it to the idea that it's people's ability or desire to borrow from tomorrow, to consume from tomorrow rather than today. But I think now, so far down this debt road, it is linked to the point that it probably can't be unlinked in a very easy way either.
Yeah, and the real issue I have, and this is most concerning, is that the only way the US dollar can retain its value is to expand debt. 95% of people do not understand that. They say, why won't the US government pay back its debt? It's because the literal rule set by which the USD framework and why it is the way it is basically dictates that debt has to expand. It has to expand. Most people do not understand this.
Which also makes the dollar less valuable. Like your argument, how did you frame it? That the only way for the dollar to keep its value is to keep expanding debt, but inherent in that is a devaluation as well.
Compared to other currencies. So this is where so this is where things get a little bit odd, right? Is that if you put all the countries around the globe into a USD denominated debt, and the USD is going up higher in comparison to their local currency, then they are literally a debt serf to the to the US. And that's the reason why world reserve currencies have always been able to kind of oversee the rule set, right? Is because they were able to issue debt and then basically take the goods from other countries, like raw goods. And that's exactly what's happening in the United States. Now, kind of going back to Bitcoin, that's where this all kind of comes into a framework. And not just Bitcoin, but if you think even about these stable coins, I was listening to a podcast more recently, which I fully agreed with some of the facts that were presented, is that Tether has been a stable coin that's been issued for many, many, many years, and the U.S. government has never gone after them, right? And that they're likely a very construct of the U.S. government. And why wouldn't they be, right? They're issuing USD on behalf of, let's just say it is the U.S. government. And who's using them? Well, the globe is. If you look at like South America, for instance, that they are using stablecoins as a means to transact value. So they're not using their local currencies. They're using the USD, right? So when I say that Bitcoin or other digital currencies like stablecoins are going to be used from the means of the U.S. government to support the future debt expansion of the USD. What I mean by that is that not only Bitcoin is going to support that, but it's also going to be these USD stablecoins, which these other countries are already using in a very large scale that most people don't understand. And it's because these individuals, from a local perspective, are trying to preserve their value in comparison to their local currency, which is being devalued. And while, yes, gold may be going up in value or silver may be going up in value, it's not as liquid, right? They can't go to some other kind of local, artisan or workshop or, what have you, and exchange silver or gold for, raw goods. It's easier to do that via Tether or via, a US dollar. And so that's what's happening. It gets very complex with these, these transaction systems. But that's why it's so important to pay attention to. I mean, you called out rightly, Tom. It's like, analog is one thing, and then there's also the digital form we still need to pay attention to. I absolutely agree with that. It's so important. But it also relies on analog forms of raw goods. That's the key, right? Someone has to be mining all of these raw goods to substantiate its infrastructure, right? And this continued energy investment when energy supply is going down. So it's really important to understand this as just in your brain. Just understand that there is an infinite raw goods and energy in the world, right? There is a limit to that, right? Whereas from a digital sense, if people wanted to put in as much time as they want to in this digital framework, they can do that, right? And it's unknown how much of that digital framework can be built out, to some degree. But we know what the physical reality is. That being said, it's almost as if the U.S. government is pushing in a whole lot of effort into sustaining this Bitcoin and this stablecoin network across the globe, and acknowledging, right, this is the rule set, is that the USD can only exist so long as its debt expands. That is absolutely key. It is an absolute rule. If that ever falls, right, whereby you start to have a substantial deflation, then it could literally break the US dollar, right? That will break the US dollar. That's why the Fed always has to come in and save the day. They always have to, bolster the economy and all this kind of crap, right? It's because the literal system of the USD is dependent on the expansion of US debt, right? And so when you understand that, your whole mindset will shift to realize what the future is and the optionality that you have as an individual, and understanding the rule set by which you're governed by. And that's something we all live in, and we have to understand that so that we can basically, define a better future for ourselves. I can't change that, right? But at least if I know the rule set, I can define a better future for myself and make better decisions for myself.
Totally agree. Tell you, Dare, you have a question or want to jump in here? You have to unmute yourself. Good.
Yeah. Hi, everyone. Yeah, I just want to jump in real quick. I like the debate because, we're trying to figure out which way this is going to go. But what I like to say is the model the U.S. debt situation it's on the Japanese model. So there's still quite some runway into the future in terms of how low the interest rate can go. So I believe at some point, we're going to move into negative interest rate because, during COVID, we're at basically zero. And for you to kind of, initiate some kind of growth, you need to go below that. So I think the model is to go the way of Japan. I mean, they've been trying to, manage their own situation. But I think we're going to go to negative interest rate at some point because, you can't use the same currency in which the debt was created to pay back the debt. It doesn't work that way. So take, for instance, the properties in Seattle or in California who is going to buy them? You can't buy those properties. So those $1 million properties, you can't buy it with the same USD. So I believe what's going to happen is that they're going to, go into negative interest rate, and this is going to devalue the US dollar significantly. And I'm not sure if Bitcoin is going to benefit from this, because at that point, there will be so much uncertainty and fear. And except Bitcoin becomes a peer-to-peer, currency. But if they're still going to convert it to USD at some point, I don't think it's going to be a good beneficiary of what's going to happen. What I think is going to happen is gold is going to go way high, and stable coins are going to be backed by gold. So it's going to be a universal stable coin backed by gold reserves of nations. So that's my own opinion. But my question for you guys on the panel is, in the next 10 years, who buys the properties in, New York, Florida? I'm not sure this next generation are able to even afford it if they were given free because of the property tax, the maintenance and all of that. How do we, or maybe there's a new money. There could be a new money, maybe stable coin or, some other form of money. But my question is, how this property is going to be bought in the next 10 years, when the boomers are, fading away, and these properties become, tens of millions. What currency do we use to buy these properties? Who buys them at that point?
Yeah, sorry about that. The old adage is, the cure for high prices is high prices. The issue we're having right now is we're staring a massive, everything bubble right in the face, and things can get crazy. They can go up longer than you expect, but ultimately, if the public is priced out of home ownership, the only way that you can maybe fix that is by immigration and bringing people from outside the country that have wealth. And we already went down that road. Now what we're trying to do is we're trying to maybe quell some of the immigration and try to lift wages and so forth to try and support the higher asset prices and higher home prices that are already existing. But you can see that as the baby boomer generation starts to age out, a lot of these properties are going to come back onto the market, and you see a lot of these investors that have bought these properties in the past for, trying to rent these things out. If you start to see migration just moving around the country to wherever the economy is best, some of these pockets of locations, which may have been the strongest growth areas of the country the last 10 years, could become, almost, an exodus and a price decline going forward. And we've seen this. I mean, this is not anything normal. This is very typical and historical in the U.S. real estate market. I mean, either that or you get into a situation where you just get into complete economic warfare, and somebody we try to inflate our way out of this mess by printing money. And also, by the way, you don't necessarily have to go into negative rates. You could just do a negative real rate of return and try to grow your way out by growth. And that's what they're trying to do, I think, with this digital age, is trying to create enough GDP and tax revenue to try to start having a positive impact on the debt situation and so forth. But if you look at the tariffs, for example, the tariff revenues is bringing in positive dollar flow, but the profit margins are getting crushed. So it's almost a trade-off when you look at corporate tax returns versus the tariff tax revenue that's come in so far this year. So, but this is the problem when you kick the can down the road for 20, 30, 40 years, and you have a system that's completely rigged and it's designed to inflate or die, and you have a complex of very few players that are becoming more and more controlling over the aspects of this market, controlling the narrative, controlling some of the, direction and price action. AI is, if you want to look at it from the trading standpoint, these AI models can go in, just like in 1987, which I don't know if most people remember, but in 1987, what perpetuated the crash was this idea of sort of a downside protection insurance that was being sold on Wall Street, basically kind of like a put strategy, where the market starts going down. This would actually kick into gear and start buying puts or shorting shares as a form of hedge or protection. And then as it kind of self-perpetuated and got into a loop, it almost created it. Well, it did create the crash. I mean, you could have a very similar event happen where passive starts to get out. Instead of becoming a net accumulator, they become, well, now I'm retired, I need funds to live on, and they start selling. That selling begets more selling. And you almost need price levels to be able to freely move and to correct. Otherwise, this younger generation is not going to be able to afford housing. I mean, they're being priced out of it. And that's and I think the younger generation is much more maybe sympathetic to socialism because of what they're seeing and what they can afford, and they're like, how else can I live? I mean, the cost of living, the cost of transportation, of trying to buy a car, everything has gone up in their world. And that's the unfortunate thing that I see, that that's the downside of asset appreciation and deflation, or sorry, this depreciating the currency to try to grow your way out of it. This is the downside. And then the flip side to that is, once the socialism kind of breaks apart and you have outright frustration and disruption in the social scene, then you start to see the fascism or the controlling of rules and behavior. And that's a very dangerous thing. I think that was one of the risks that I had built into my model back in 2008, 2009, when I started looking at this entire, when I was doing a depository, I was looking at social chaos as a real risk, fascism as a real risk besides socialism. And, that's one of the reasons, as an investment advisor managing money, I was like, well, there's no way to actually hedge that risk in the paper markets. Yeah, you can buy puts, but as we saw in 2008, the counterparty was going, you make money off the losing party. And if the losing party can't pay, you're kind of out of luck. So that's the bigger picture. Right now we're just taking one step at a time. You're watching the markets melt up. This is the part that for a lot of people, it doesn't make any sense. The whole thing, you're seeing, like channel stuffing and, giving money to one corporation, gives their chips, buys $1 billion worth of chips or something like $2 billion of chips, and then takes a percentage stake in the company because they're buying a boatload of product. Well, if everybody was doing that, this would be an absolute insane market where people are buying product and they get an ownership interest in the company at the same time. But this is what you look at when you're looking at the behavior of a bubble. It gets insane. And it could get a little bit more insane before this thing starts to hit reality. And that's where the metals, to me, comes in, because at least there's a grounded historical notion of, hey, this metal has been around for 5,000 years. It's lasted through every empire in history. It's not going to go to zero. It's something I can pass down. It's not going to expire. That's what I think the allure of the metals represent when you get into a true type of insurance policy, or I think that's what a lot of high net worth individuals are looking at when they say, listen, 2%, 5%, whatever it is, percentage of my portfolio, this is what I view it as that insurance policy that, if I ever need it, it's going to be there for me.
I agree with that, Bob. And there's a couple interesting examples, of the housing market. Going back to this idea, or the example of Japan that the guest brought up. At one point, I believe it was the Central Park or something in Japan was the most expensive piece of real estate in the world. And when that all collapsed, all of a sudden they realized the error, let's say the error of their ways and what the yen was actually worth. And Bob, I think, correct me if I'm wrong here, but I think we've maybe just now surpassed the previous all-time high that was 30 or 40 years ago in the Japanese stock market, going back to this idea of nominal returns, right? Again, to reiterate, the cure for high prices is high prices. And at some point, this is going to rebalance. The bubble can't just keep getting blown up forever because, inherent in that question about who's going to buy these houses for $10 million plus dollars, just an average house. Well, if there's not enough currency or demand within the market, those prices won't even get to that level. Anything to add there, Bob?
Yeah, and not only that, the maintenance and the insurance costs. Insurance companies are dropping people. They're ending coverages. They're just walking out of the state. I mean, when they see risks like this, like Florida's having a big problem with a rising cost of insurance. Especially when it comes to hurricanes, that type of thing. But the cost to replace a roof. I mean, these are things that are. This is the part that tends to start to add reality to. It's nice to have a high price on your home, but now to actually, if something does go wrong or just normal maintenance occurs and it costs more than what your income is, because a lot of people that live in Florida are retired and they're living off a fixed income, and and inflation has been so rampant that a lot of these material costs and labor costs are eye-opening to a lot of people when they actually do need this work done. But this is, again, this is the ebb and flow of the markets working. It's very frustrating to watch this, because what you don't want to see is a bubble get out of control and then go vertical. And I saw this in 2000, where everyone thought, my God, this is insane. The NASDAQ took off in August of 1999. And then in December, the entire month of December, the NASDAQ doubled. And then from January to March, it doubled again. Just when you thought it was really crazy, it got even crazier. And you don't know where this thing's going to stop. But the problem is it sucks everybody in. And when it tops, that last buyer buys, there is nobody left to buy. And that's the scary part, is that this thing could start to head down very quickly, unfortunately. And there's not enough. It's like I keep saying, it's like a gorilla trying to get out of a bird cage, all at once. There's just not enough room to do it. And that's the part where, at least with physical metals, yes, the prices can go down, but an ounce is an ounce. The reaction from the government will basically be to try to print their way out of it again, be even more supportive or more stimulative. But that doesn't mean that now asset prices go up. That could push asset prices up. But now you have a cost of living issue and just general asset prices and commodities overall that start to, that's where the inflation becomes toxic. From the early parts of inflation are always beneficial to the asset markets, because people don't really notice the costs going up as much as they are. And it's eating the asset markets much greater. But now you're starting to see every dollar added, does generate, a little bit more inflation. It does create that disillusionment, as well as, the concern among the public of, well, wait a second, there's no way we're going to pay this stuff back. So, but that's the bigger picture. That's when you start looking from the 10,000 foot view on the metals. And that gives you your more longer term perspective.
Mm-hmm. Bob, when you asked me about what I'm branching out to on this channel, did I answer your question earlier?
Yeah, no, it's awesome, because I think a lot of people may not, but maybe the story will eventually come out one day. But at least to kind of know what you're doing, because a lot of times, especially in social media, you leave one podcast or one content venue, and it's very difficult to find you or find someone once they move. And so I think it's always great to kind of re-inspire everyone to say, listen, I haven't changed. I'm still doing this, and I'm going to do it better this time with this new format. I think that's great.
Yeah, I don't know that there was anything, let's say in particular, that I wanted to do better, but let's say this version of content that I'll be putting out, I think will be more authentic to me and some of the other interests that I have, and I still want to be able to provide the value that have come to expect from me over the last 5.5 years here. So I'm very appreciative again of everybody finding me at the new show. Like you said, Bob, it is kind of hard for people to find you, but it'll happen, and I'm happy to work hard to make that happen. But I really appreciate everybody's input today. We've been going for over 3 hours here, so I think that's time to cut it off. Bob, always a true pleasure. Always very grateful for all your time and input, and really appreciate it. Thanks, everyone.
Sure. Thank you, Tom.